morning. It is Monday, February 6th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi. And if you take a look at futures here this morning, we are seeing a downdraft. That's as investors prepare for another week of earnings, as well as, and this is probably more pertinent to the futures, some Fed speak. We're going to dive into all of that and more. But first, here are the three things you need to know this morning. The United States military has shot down a suspected Chinese spy balloon that was flying over the Carolinas. Concerns over tension between the two countries is sending U.S.-listed Chinese companies lower. We're going to dig into the implications.
Dude, you're getting a pig slip. Dell, the latest to eliminate jobs with over 6,000 set to be let go. That is, the tech industry continues to see cutbacks throughout the entire sector.
And the Fed in focus yet again as Federal Reserve Chairman Jerome Powell set to speak on Tuesday. Could we see a more hawkish tone? We're going to discuss all that and everything you need to know and should be keeping an eye on this week. But as Julie said, the number one thing to know today is the fallout from the United States taking down the Chinese spy balloon. Let's take a look at how this is impacting some China stocks right now here. And we've got the Nasdaq Golden Dragon Index pulled up here for you. A few of these, of course, are going to be the U.S. traded companies, but you can see even some of the moves that we're seeing pre-market here as labeled underneath. Alibaba, that's down pre-market by about 2.3%. JD.com also about the same on a percentage basis. Pinduoduo, that's also down by about 3.6%. Now, let's remember this comes in the context of many of these names over the course of this year thus far having been up. In fact, you'd be hard-pressed to find any red on this screen. We've got three spots there particularly, but with the context of Alibaba being up 20% year to date at this point in time, a lot of these are seeing pre-market moves to the downside here this morning. And so the impact and fallout of this Chinese surveillance balloon will hit more than just stocks. Let's bring in Yahoo Finance senior columnist Rick Newman. Rick, good to have you here with us this morning. All right, help us break this down from the U.S. China relations standpoint.
It's not a surprise that China would be spying on the United States. What is a surprise is that they would either do it so blatantly as to deliberately send this balloon across U.S. territory, or that they would screw up so badly. And we don't really know which it was. I guess the prevailing theory for now is that China just screwed up. This either was not supposed to enter U.S. airspace, it was perhaps supposed to come close, or something else went wrong. So the most obvious bit of blowback here is that Secretary of State Tony Blinken, he was supposed to be in China over the weekend. He canceled that trip, of course. Now that will probably get rescheduled. But I think both sides realize that they want to get back to whatever you might call the normal state of relations between the United States and China at this point. U.S. relationship with China has been hardening during the last several years. It began with President Trump imposing tariffs on Chinese imports, and Biden has taken a hard tone toward China as well. And this comes as Chinese President Xi Jinping, he's now the so-called president for life. He's entering his third term. There probably will be a fourth and a fifth term if he lives that long. And he's become a hardliner. So the United States and China need to talk to each other, but they're not saying much for the moment.
What's interesting about this whole situation is, I mean, I think it's sort of unspoken but well recognized that there's Chinese spying in the United States in a number of different ways, right? There's probably U.S. spying in China in a number of different ways. I guess it was just that this was such a visual and blatant reminder that that is happening, right?
And so clumsy and so visible. I mean, what's remarkable? I mean, the public almost never gets to see spying efforts flying across the sky, and then get to see, a missile. I mean, shooting the balloon down. So that image there shows a lot of equipment on the bottom of that balloon. And people who think they have this all figured out need to remember that there's a lot we don't know. There has been a lot we haven't known the whole way along. So the Pentagon now is going to be recovering the debris from this balloon from the Atlantic Ocean. And they're going to figure out what was on there. Was it optical sensors, radar sensors, cameras, aural sensors, technical sensors? What exactly were the Chinese trying to figure out with this balloon? And as many analysts have pointed out, China does have reconnaissance satellites. So they probably were not sending this balloon across the United States just to look around. They can probably do that with cameras on satellites in orbit. So what exactly was this balloon supposed to accomplish? We will perhaps get some additional information about that. But remember, that we gather intelligence on other countries' intelligence gathering capabilities, and the Pentagon is not likely to publicly announce everything it's able to learn about what this balloon was actually up to.
Yeah, if it was indeed trying to track weather patterns, probably would have had a better chance being a customer of Planet Labs. Rick, when we think about what the implications of this are now going forward, I mean, there's already been a trip that was now scrapped from one U.S. representative that was going to be making a trip to the Asia-Pacific region. What does this mean now for kind of mending or at least opening the door for discussion between the two entities?
Well, the two countries are going to remain talking. Both when something like this happens. I mean, let's remember this is a gigantic embarrassment for China. Either they got caught doing something they didn't intend to get caught at, or they just simply screwed up big time. So both sides have to address their domestic audience when something like this happens. So the Biden administration has to appear tough on China, and of course they've been getting bashed all week for not shooting the balloon down sooner. I guess the critics think that they should have just sent whatever equipment was on there raining down over Kansas or Montana or North Carolina or whatever it ended up. I think letting it drift into the ocean before shooting it down seems to have been the right call. China has to address a domestic audience that it realizes China is now facing some embarrassment. There have been worse incidents between the United States and China. And these nations do find a way to get back to talking to each other once everything settles down. But it's really important to underscore that the United States, but the relationship between the United States and China is growing increasingly tense. Just one example of that we've seen from the Biden administration are these new export controls on the sale of semiconductor technology, advanced semiconductors, and any kind of intellectual property associated with that type of technology. That is one of the toughest sanctions the United States has ever put on China, and some other nations are now joining in on that. So we are, some people say we're entering kind of a Cold War between the United States and China. I think that goes a little bit too far at this point. There's still a lot of trade between the two countries, but this is a tense relationship, and it's going to stay that way.
Rick Newman, appreciate the analysis.
Hi, guys.
All right, the second thing to know this morning is surrounding another set of layoffs, as Dell is the latest to announce a round of job cuts. The computer giant set to terminate over 6,000 jobs. Now, we spoke with Intel CEO Pat Gelsinger last week about the landscape of the PC market. Take a listen.
Fundamentally, post-COVID, the PC is a more critical device. And with that, this inventory correction, we're still in the, 270 to 275 million unit range is our expectations, for this coming year. We set a range of 270 to 295, we believe at the lower end, but the sell-in rate is dramatically below that today. And that's why you say at some point, they just got to start replenishing to the sell-through rate.
I'm starting to wonder here, guys, this is a big number on paper for Dell, but in the context of their broader employee base, not a lot. And given the ongoing correction in the PC market, is Dell cutting enough? Just given how much inventory needs to be worked down in this space and how much their margins might be impacted.
Well, you hear about some companies that are saying that we overhired over the course of the pandemic. Dell has been cutting staff for the past 2 years, roughly here. The last time that they increased staff was between 2019 and into 2020. From 2020 into 2021, it moved lower by about 4.2%, 4.25% there. And then in 2021 into 2022, you had roughly a 15% decline in their staff. So this is almost a continuation of what we've already seen from Dell. It does show a shift in some of the consumer appetite, at least right now. And then on the business to business side for Dell as well, perhaps shows some slowing down that they're seeing in those net new portfolio clients that they're bringing on.
Yeah, a couple of additional things to note. Because of that gradual whittling down in staff, after these cuts are completed, it'll be the lowest total number of employees at Dell in about 6 years. Wow. So, as you say, it's not exactly the same roadmap we've seen from some of these other tech companies. On the PC front, IDC was out with some interesting numbers earlier in the month about what the fourth quarter looked like for the PC makers. And Dell not doing so hot here. If you look at their declines, there was a drop of 37.2% year over year in their shipments in the fourth quarter to 10.8 million. So they are the third largest PC shipment maker, or PC maker, in the fourth quarter, that is, in terms of the number of shipments. But a lot of these, yes, they were down the most, 37.2%, but none of these guys did very well, with the exception of Apple, which was down only 2.1%. So you definitely do see you see some differentiation among these companies, but it's not huge.
You do, and I think you're starting to see that differentiation on a cost basis. So Dell shares down about 29% the past year. HP, Hewlett Packard, those shares are only down 19%. And I think that's why you're seeing Enrique Lores count early last year, laying off a large, I believe it was over 10% of the workforce. So you think HP is a little more out in front of this PC correction or slowdown, and the market is trying to figure that out there.
Yes, indeed. And the third thing you need to know today, the Fed remains in focus this week. Markets will likely be on edge ahead of a speech by Federal Reserve Chair Jay Powell on Tuesday. Powell's disinflation comments last week sent the markets higher. Could we be in store for something similar when he speaks again tomorrow? Let's take a quick look at the week ahead with Brad.
Quarterly earnings, consumer confidence, and the State of the Union all coming up this week. Here is what you need to know.
Ready for this?
The week's big earnings report comes Wednesday from Disney, the first one since Bob Iger returned as CEO. Revenues are expected to be up about 7% year over year, with a slight decline in profits. The stock's on a roll, though, up 25% in January, easily beating the broader market. Disney's Black Panther and Avatar sequels, they dominated the quarter's movie box office performance. On TV, President Biden will speak to Congress and the nation for his second State of the Union address. Among the top issues expected in Biden's address, inflation, the economy, gun control, police reform, and the war in Ukraine. And the markets will be anxiously awaiting the delivery of the newest consumer confidence numbers. The University of Michigan numbers come out Friday. Latest reports show consumers are not feeling that great about the economy. The Fed's aggressive rate hikes hitting consumer spending hard, especially for big-ticket items like cars and houses.
Let's talk more in particular about the Fed talk expected tomorrow. Michael Sheldon is joining us, RDM Financial Group and Hightower CIO. Michael, it's great to see you. There is now a lot of talk that maybe the market misinterpreted Jay Powell's commentary last week as being too dovish. Do you think that's true? And if so, are we going to hear him try to correct that tomorrow?
Yeah, it'll certainly be interesting. I mean, the markets overall have benefited from a number of tailwinds over the past several months. So we had falling inflation, we had falling interest rates, and a falling dollar. Those all helped the markets bounce off their October lows last year. And then just over the past couple of days or so, we had the Fed meeting last week. So the Fed raised rates by a quarter point as expected. But in his testimony following the statement, Fed Chairman Powell mentioned the word disinflation 11 separate times. So that sort of indicated to the markets that we're closer to the end of the current rate hiking cycle. And I think that the Fed is aware of the fact that inflation is coming down. And then add on to the fact we had a blockbuster jobs report on Friday, and that certainly provided further fuel. So Tuesday will be important for the Fed because I think to the extent that Powell may push back a little bit and maybe be a little less optimistic in terms of how much more the Fed is likely to raise rates and and the fact that the Fed is likely to keep rates unchanged for a period of time, that could at least cool the markets off just a little bit.
Well, then, to that point, Michael, do you fade the move in tech stocks?
I'm sorry, say that again?
Do you fade the move in tech stocks? Tech stocks seem to have rallied based on what Powell said last week in terms of disinflation. I mean, do you still like tech stocks here? What do you do with them?
All right, good point. So last year was an unusual year where over the past decade or so, growth stocks have outperformed value stocks. And investors have gotten burned trying to give up on growth stocks and large cap tech stocks too soon. Last year, again, was an unusual year because we saw high inflation and rising interest rates. I don't think inflation is going back down to 2% immediately. It is heading in that direction. But more importantly, interest rates are probably not going down to the level they were. At the beginning of last year, remember, short-term rates were at 0%. Real rates were negative. There was $18 trillion of negative yielding debt around the world. So I think interest rates are coming down off their highs, and we're likely to see the Fed move to sort of a pause this year. So I think there will be a place ultimately for tech stocks to participate in the market rally, but I think it's too soon to say we're just going to go back to the market leaders that were the leaders for the past decade, at least right now.
Okay, and so for anybody who's trying to, I guess, best anticipate when the Fed might pause or when that pivot may look apparent, when and how long do you believe the Fed is going to need to see that trend? And then for the markets to be able to anticipate that pivot is coming?
Well, I think it's clear that inflation is coming down, especially on the good side of the economy. What the Fed's been watching is the sticky kind of inflation in things like healthcare, in wages, and in rental apartments. So even there, we're starting to see some signs that these are coming down. And if you look at a number of commodities, for example, if you look at steel, natural gas, lumber, those are coming down, even wheat prices. So inflation overall is coming down. The part that's sticky is the part that's wages. And it's interesting that even though we had a blockbuster jobs report on Friday, wages actually declined slightly on a year-over-year basis. So the difficult part for the Fed is this is an unusual type of economy, and I think there are going to be twists and turns throughout this year. When you think of the R word, I was thinking about this, when you think of the R word, you typically think of recession. And we think there's probably going to be a shallow recession as we go through the next several months into the summer, but that ultimately investors will look ahead to a recovery in the economy and corporate profits that we had into 2024. So there will be some twists and turns as we go through this year, and investors will have to have a little patience.
And as they have patience, Michael, what should they be doing strategically here?
Well, I think, again, the last 10 years were all about being in the U.S. and being overweight growth versus value. What we've seen is the equal-weighted S&P 500 has outperformed the market cap-weighted S&P 500 over the past year and a half or so, maybe a little bit longer. And I think if investors were very overweight tech, I think you want to move a little bit more to the middle of the style box and have a little more balance between growth and value. International has also dramatically underperformed the U.S. over the past 13 years or so. And it's a little too early to say that foreign markets are going to be the market leaders, but it's something we're taking a look at, especially if the dollar has peaked and is starting to go down. That should, in theory, provide a tailwind for foreign markets, although it's a little early to just make that call that foreign markets are the new market leaders.
Michael Sheldon, RDM Financial Group Hightower CIO, joining us this morning. Mike, thanks so much for the time. We appreciate it.
Thank you.
Absolutely. Let's get to today's morning brief, your daily update on what's making moves in the market. Markets continue to be unclear on just how hawkish the Fed could get in the weeks and months to come. The so-called dovish pivot was the talk of the town, and we'll get more clues on that with Jay Powell speaking this week. The big worry, markets are acting like rates are set for a cut this cycle, but are they really? That's the big question. But everything from earnings to economic data indicating a pivot pushback until later this year. Here's what BlackRock Global Chief Investment Strategist Wei Li had to say on Friday. Take a listen.
Beyond FOMO and chasing momentum, it's hard to see a fundamental reason for stocks to keep pushing higher.
Fear of missing out, or FOMO, could be fueling investor optimism. Don't be the last one holding the bag here. And so we had this conversation, yes, and Wei Li did bring the FOMO part of the equation back on the table here. I know you wrote up today's morning brief here, and so your biggest takeaway from Wei Li on that?
Yeah, I was fired up. I had a great 2.5-hour workout on Saturday. I went right home, and I was inspired by what Wei Li told me. I got right on my kitchen computer and just started writing this, and really, I was just angry. I mean, I just see this market continue to push higher despite clear signs corporate America doesn't deserve this major push higher in stocks. You look at the earnings season data here, 70% of S&P 500 companies report a positive EPS surprise for the fourth quarter. That's below the 5-year average. Earnings for the S&P 500 are tracking down about 5.5%. You have Starbucks coming out here with an ugly quarter. You have Amazon, Meta, ugly quarters. All household, even Apple, big earnings whiff. All these household names reporting disappointing results, worrying earnings calls, tones by the various executives leading the companies. It just doesn't seem to justify how far the market has come out of the gate here.
But it's about the future, isn't it?
Well, the future, according to some of these tones and some of these raw numbers, is not so bright.
Some of them, I don't know. I think people are looking for a reason to be optimistic.
You're just trying to fire me up even more.
Yeah, sorry. I'm just calling it like
when
I
they're
see
buying
it,
their
right?
$7 eggs, they're looking for something to be happy about.
I mean, listen, after the past year that investors have had, and after the wipeout that some of them have seen, I think, yes, there are definitely people who are cautious, but there are also people who want to get back in here and make money.
But are they going about it the right way? And I think what Wei Li was saying was it's just FOMO, fear of missing out. Are you just buying that stock because you want to be left holding the bag, or moving, not getting into tech stocks on maybe one word from the Fed chief on that he might pivot on rates, and really losing sight of the core fundamentals of some of these names?
Should I remind you of one of the tenets here that we talk about all the time?
Stocks usually go up.
Stocks go up.
No.
Stocks usually go up. Depends on when you need your money.
Right.
But stocks as a whole tend to go up over time.
Wow, is that a prediction?
No, it's just it's a truism. I don't know what it is.
It's just a matter of of whether investors at this level believe that we're actually going to retest some of the lows of late last year, fourth quarter of last year. And if they don't believe that, then now relatively still might be a good time.
Never good to hold the bag. All right, markets digesting the wider picture this morning with a strong January jobs report, seemingly good for the economy, but it could mean a longer period of hawkishness from the Federal Reserve. Joining us now is Howard Silverblatt, longtime analyst at S&P Dow Jones Indices. Howard, always great to get some time with you. And I'm sure you just heard a discussion on the health of this earnings season. What has been your takeaway? Do you think corporate America has been reporting enough to justify valuations at these levels?
Bottom line, no. We're still dealing with almost a 21 PE on the current earnings and about a little bit under 19 for 2023. That is very hefty. We are paying for future earnings that are not here yet. The numbers, and you mentioned the beats, yes, they're coming in very well. Not significantly better. The numbers aren't that good. But if you compare them to where the estimates were about 2 months, so the estimates have come down, and that's why these earnings are looking better. On that FOMO item that you were talking about, by the way, I think it's a matter of duration, how long you can hold it.
Howard, I think we're having a little bit of problems with your audio for some reason there. So hopefully our folks can get that in order, and we can check back in with you. Maybe it was a mic issue for Howard.
But I think Howard just reinforced what we were trying to say in the morning brief here, guys. Valuations they've really exploded. We've seen this market being driven by higher price to earnings multiples, and the earnings have not supported. Earnings are still expected to be down, and at least in the first half of this year, they can continue to still be under pressure, even despite a lot of companies cutting costs.
Yeah, and when we were talking about what might be driving some of that FOMO as well, I mean, we're about 15% off of those S&P 500 lows that we had seen in October of 2022. For any investor that's looking across some of either the battered tech space and trying to figure out, okay, if we even though we have seen some of the worst performers of last year, whether it be for the meme stock type of trade or momentum trade, or whether it be because there actually is an effort to try and price in the bottoming of or finally get behind us all of the ripping of the Band-Aid that's taking place early on this year as well. If anybody is factoring all of that in, then they might say at this level still, okay, yeah, if my long-term time horizon looks 3 to 5 years out from now, then perhaps this is a good place to actually set some pegs at as well.
And one more point I would make is that, if you're looking for sort of speculative enthusiasm in the market, is it still there? Is it still alive and well? Look no further than anything with AI in the name, right?
Yes.
We've been talking about this theme that these stocks have been flying high because investors are looking 3 to 5 years out perhaps, and they want to get on to the next big thing. So, maybe just some of this is human nature, right? That people look at the past, they say, well, I didn't buy Amazon when it was just selling books. And, I think there's this natural desire on the part of a lot of retail investors to kind of try to chase the next big thing.
Good thought indeed there, Julie. All right, coming up, Tyson's profits took a hit last quarter. We'll chew into the chicken producers' results next. Shares of Tyson Foods getting grilled this morning after missing analyst estimates in its latest quarter. Company reporting a 70% drop from the prior year in its adjusted earnings per share. CEO Donnie King citing market dynamics and operational inefficiencies impacting profitability for Tyson Foods. Bottom line, not a good quarter from this company. Interesting shift potentially here. So in the pork division, we saw prices up 1.4%. The volume for that division fell 7.4%. Looks like people dropped pork and went into beef. Beef volumes up 2.9% despite even with or look like an 8.5% price decrease. So bottom line is rotation from pork into beef. So they're going long beef, short pork.
I just want to put a fine point on how terrible these numbers were.
Yeah,
these numbers were
awful.
Terrible. The GAAP earnings per share, 88 cents. $1.33 is what analysts had been looking for. And the sales didn't look as bad. It had to do with margins. You just mentioned pork. Operating margins of pork were negative 1.4%. You don't see a negative operating margin too often. So basically, they were just caught up in a situation where you've got prices falling for many of their proteins. Mm-hmm. But in some cases, they're still paying higher prices, even though the prices for consumers are falling.
They got roasted, Julie. They got roasted.
They got roasted.
Yeah, it was almost something where I had to clean my glasses off when I was looking at these earlier on, because, I mean, you look at some of the year-over-year comps on the operating income front. This time last year, for this quarter last year, they were bringing in about $1.5 billion here, brought in $467 million in operating income this year. And it does come back to all of the different price fluctuations as well. You were talking about beef and pork. Well, the average price change for beef, that was down 8.5% versus the up 31% year-over-year estimate, or the estimate was for down 7%, was down a little bit more than that. But you compare that to last year when it was up 31%. So a massive wipeout there.
Yeah, not to pull all the feathers out of this company here, but there was a positive area on the prepared foods. The operating margin's up 220 basis points year over year, and that fits with some pretty good overall results from the prepared foods players, Conagra Brands, you name it. PepsiCo reports earnings later this week. Some of these companies have had a lot of success pushing through higher prices, and in the case of Tyson, that's Hillshire Brands. Well, gotcha. And Ballpark hot dogs.
No working
Ballpark,
there. But
chicken nuggets too.
Chicken nuggets.
Yeah. Not working elsewhere though. Besides those finished products.
This quarter really flew away from Julie.
I was looking to see if the transcript of the earnings call was up yet, if there was any talk of eggs. Even though Tyson doesn't sell eggs directly, maybe there would be some implications for the
I see where you're going.
Flocks.
Chickens and eggs.
Which came first?
I don't know.
All right, let's talk about as we head.
We could really go down the rabbit hole with this stuff.
As we head to the opening bell this morning, here's a look at the futures as we see declines across the board here. The Nasdaq in particular indicating a drop of nearly 1% when it opens up here this morning. It does seem like all of this reflects a lot of trepidation about what we're going to hear from Fed Chair Jay Powell tomorrow. Is he going to come in and smack down some of the optimistic pricing that we've seen in the market?
Caused by him?
Caused by him. I mean, that's the thing, right? He was given several opportunities after the Fed decision last week to say no, pushing back against a loosening in financial conditions, and he didn't do it.
This market was going to go buck wild when he noted the word disinflation. We've never heard disinflation from Jerome Powell, at least not in the past couple of years, because it hasn't even existed.
Right. So all of that said, who knows what he's going to say, right? So there's this level of unpredictability here in the market right now, even as Saz here, speaking of unpredictability, thinks about more poultry puns. Brad?
The streets are saying that Fed Chair Jay Powell walks into rooms like Lil Uzi Vert walked onto the stage at the Grammys last night.
Is that what they're saying?
That's what they're saying out here. Markets this morning, we're taking a look at some activity for the major averages in just a moment. There they are. We're down by about 0.3% here out of the gate. Let's populate this chart for you, give you a little bit of a sense of how we're coming into this week. Over the past 5 days, net higher by about 0.3%. Nasdaq Composite, you're seeing that lower by about 0.75% right now, about 0.7% to the downside there. Past 5 days, though, still positive and handedly. It's up by about 4.5% over that period of time. And then over the past 5 days for the S&P 500, you're seeing that hold on to gains by about 2.4% here. Out of the gate, though, this morning, that is down by about 0.5%. Let's also take a look at the 11 S&P 500 sectors here. To begin the day, let's put this on an intraday view for you folks. There we go. All right, we are largely leading lower here this morning. Amazing what changing that time scale will do for some of the colors on this screen. Energy, you're seeing that higher by about 0.6% here out of the gate, but bringing up the caboose here, XLRE, real estate, you're seeing that lower by about 1.4%, but largely more laggards than gainers. And then let's also just take a quick look at the Nasdaq 100 here. For some of those mega cap tech stocks, a little bit of weakness to begin this new trading week here, where you've got Apple that's down by about 1.4%, Amazon holding on to fractional gains here, but then additionally, hey, look at Tesla, computer on wheels there, and more. It's up by about 3.1%, so strong start to the week for the EV manufacturer.
Yeah, there's some talk about Model Y pricing coming back up. We're going to talk about that later in the show. In the meantime, though, we got to talk about RH, formerly known as Restoration Hardware, of course, is restating its earnings results for several periods after uncovering mistakes in its calculations. The retailer, though, saying the restatement is unlikely to affect its GAAP net income. But that's not all. It also came out with some other numbers, some other preliminary numbers here from the company. It sees its revenue for the full year at the low end of its 3.5% to 4.5% decline estimate for sales. So that doesn't help matters either.
Zero surprise on this company's guidance. We'll leave the accounting thing aside. We had CEO Gary Friedman come out months ago. I remember covering it because it has been ultimately one of the most read stories on our platform in the past 6 months. He said that the housing market was collapsing. When you see a CEO get on their earnings call and tell the investment community that the demand for their product is essentially collapsing because the market around that product is collapsing. It is just a huge, huge red flag, and the street has, I think, just continued to love this stock, wrongly love this stock. Now, also note this, too, and Citigroup pointed this out this morning. Despite all the challenges in their marketplace, here's a company that spent $1 billion to buy back their own stock last year. What a horrible investment, just given how far the fundamentals have turned for this business. I mean, look at that stock price. It's dreadful.
Well, it is. And taking a look at, of course, the different divisions that they have and how this is also a company that really was selling into the time period when people were, or households were thinking about buying that extra house, that ski house, that beach house even, and then being able to Airbnb it or rent it out or just have another property that they could use as an investment. And then with such a drastic market shift that we've seen as the Fed continues to really loom large over what the rate environment looks like, I think for Restoration Hardware, it's how did you not get a sense that that was going to be coming as well, and where that eventually needed to shift some of the business strategy also?
Some of this stuff has cost more than my car in RH.
The mirrors cost a lot.
It's mind-boggling. I mean, bring some of those price points down. Help me out. Help me out. I want to buy some RH. Just can't get there, Julie.
I think you'll have to shop somewhere else.
Or work harder. You're telling me I have to work harder, right?
No.
Or change careers.
Please don't work harder. Yes, the latter, maybe.
Yeah. We also got to talk about Children's Place this morning, too. Shares of Children's Place taking a hit after the retailer cuts its fourth quarter outlook, with expectations of reporting a loss per share amid a deterioration in its gross margin, citing a challenging macro environment here. There you're taking a look at some of the metrics as well that they had come out with. But this was an interesting one to really hear about, especially for the children's specialty apparel retailer here. And I think they had also mentioned within this, as a result of the challenging environment, higher input costs, decade-high cotton costs, which that caught your attention as well, Sazi, as well as some other supply chain costs. That's what led them to update the street on what they're expecting here and the negatively impacted short-term margins as well.
Yeah, this isn't, I wouldn't say, a CEO operational issue. Jane Elfers, longtime CEO at Children's Place, she's really great. I mean, she's done a phenomenal job rejuvenating that brand. But if you take a step back and just overall look at what Children's Place is, it is a brand in a mall that is seeing challenging traffic, the mall itself, that focuses on middle America during an inflationary time. And this is, I think, this customer base went to a Target, they went to a Marshalls, they've gone to a Walmart the past 6 months to save money, and Children's Place has been impacted, and it is unclear when that turn in the business, when things might start to improve.
And P.S., the kids' apparel at the likes of a Target is good stuff.
Not bad.
They have that Janie and Jack brand. They have some other strong kids' clothing. So, you know, I found myself wondering as they were talking about spiking cotton prices. I mean, you know, a lot of clothing is not made from cotton anymore, but I wonder if the mix in children's clothing still skews more cotton. I don't know if that is the case or not. But I don't know if, I think it's already the majority of clothing that is purchased in the U.S. is petroleum-based, if I'm not mistaken.
Interesting. There's also such a dynamic shift in how much children's clothing is being pushed, or not pushed, purchased, because I think more parents have come around to the secondhand, some of the different opportunities on the market to just say, okay, yeah, I will go into either a secondhand platform that says, because my kids are just going to grow out of this so quick, then what's the point of purchasing it and then holding it? Or you just have family members where you just create your own little network of these things.
All about it.
Yes.
All about it. But I do, you know, but you got to supplement sometimes
Get some
with
good
the new
stuff
stuff as well. And you can't, I was going to say you can't do secondhand shoes, but I have done hand-me-down shoes.
Hashtag mom hacks. Mom hacks.
True.
Yes, exactly.
Guys, coming up, Yahoo Finance's Jared Blickery going to break down the latest market action to kick off the week. Plus, we're going to speak to an analyst behind the bullish call on Darden Restaurants. Oh, yes. Bring on the free salad and breadsticks conversation. That's later on in the hour. Don't want to miss it. I'm hungry.
Nice.
Welcome back to Yahoo Finance Live this morning. We're taking a look at the U.S. major averages here, red on the screen. For more context, let's get on over to Jared Blickery, who's at the Wi-Fi Interactive. Hey, Jared.
Hey there. I think some of the bearishness that we're seeing in the market this morning, kind of a hangover from last week, and I'm going to get into the charts in a second. Nasdaq leading the way down 0.7%. And if we're looking inside the market, here's what's happening early on. This is our leaders in sentiment. Looks like cannabis, MJ, that's in the lead here, followed by defense. But most of the action centering to the downside. KWEB down there, those are Chinese stocks. That's that ETF down 3.5%, followed by Bitcoin, Japan, IPOs, emerging markets, home builders, chip stocks, et cetera. Let me just show you what's happened over the last 7 days. We've seen ARK stocks and meme stocks in the lead, followed by transports, retail. We had this really nice broad-based rally, but a lot of it was being led by the junk stocks. And so that's what we see here. All this gives me pause, given the current market action, to think maybe we've gotten a little bit extended to the upside. Now, here's the S&P 500. Had a little bit of a negative day with that hot payrolls report that we saw last Friday, and we're coming down from some pretty high levels. Some high levels, I would say, not shown here is RSI. That's various indicators that show you, do things get oversold or overbought? And when they get moving too far to the upside, a lot of times they got to mean revert. So I think that's what we may be seeing in progress right now. Now, the flip side is that if we were to squeeze to the upside, you watch the S&P 500, we take out last week highs, probably going to be more fast and furious action to the upside. But here is the VIX. I'm going to show you a 2-year chart. We hit some pretty far lows, the lowest point that we'd seen in at least a year. And usually when we do that, we do tend to see mean reversion in the VIX, and that would mean a spike back up, and that would be concomitant with stocks going back down. Now, here's some more evidence. Here's a 5-year T-note yield. That is bumping up now against multi-month highs. 10-year T-note also broke to the outside. These are the things that we've seen when the people realize that the Federal Reserve is still very hawkish right now. Here's the U.S. dollar, final piece of evidence. I'm going to dial this down to a 9-month chart, but clearly we have broken to the upside here in the Dixie, and then I want to show you what's going on with the Bank of Japan, because this is pretty critical here. Let me just show you a 6-month chart. Now, let me reduce this to a line so everybody can see it. Here we go. Still in a channel with the yen here, but the yen is moving overnight, weakening, and the U.S. dollar here strengthening to the upside. Yen is weakening to the downside here, or yen strengthening to the downside here. That is happening because the Bank of Japan is going to switch out their current leader in April, Haruhiko Kuroda. The front runner, who is Masayoshi Mamma Mia, there we go. He is probably going to be the most dovish counterpart to Haruhiko Kuroda. And so if this happens, we're going to see more dovishness at the Bank of Japan. BOJ is always a lagging indicator. By the time they get hawkish about policy, probably too late. So maybe a fig leaf that we're not there yet. But the strengthening dollar, higher yields, the fact that all these markets are overbought to the upside, especially in equities, just tending to tell me that we might be in a little bit of a mean reversion environment here.
Jared Blickray, great stuff. Thanks so much. Appreciate it. All right, there's maybe some relief in sight for beleaguered investors in movie theater stocks such as AMC. Movie theater visits have begun to creep back up, as seen in our chart of the day from Apollo Global Chief Economist Torsten Slok. The rebound couldn't come quick enough for AMC. Shares are down about 60% in the past year. Coming up, is it time to chow down on shares of Olive Garden owner Darden? We have the call next. Plus, a spotlight on streaming. We'll speak to an analyst in the next hour ahead of those key Disney earnings. You do not want to miss it. We'll be right back.
Guggenheim is cooking up a positive outlook for Darden Restaurants, initiating coverage with a buy rating and a $170 price target, saying the company will continue to take market share from its competitors despite a challenging backdrop. Guggenheim senior analyst Gregory Frankfurt joins us now. Thanks for being here. So as you look at Darden, what makes it is it executing better in this environment? You also talk about in your note that there just aren't a lot of other companies doing exactly what Darden does right now. Explain to us why.
Yeah, I mean, Darden has been the best-in-class full-service operator for the last several years. Their execution and their comps have significantly outpaced peers, and it's part of the reason why they get a premium multiple. The shares trade at 12 times EBITDA, and a lot of the other peers that are of lower growth are trading at 6 to 8 times, and we think the valuation is deserved and more some.
Greg, I'm on the Olive Garden website right now, of course, owned by Darden. And for Valentine's Day, they're teasing $18 wine bottles, $6 take-home meals. Those are really good deals. I mean, is that a sign that they're having problems getting traffic into the restaurant, given they have had to raise prices? And do you see them having to promote more?
No, I think that's a sign that they're trying to capture the romantic customer over Valentine's Day. But to be honest, marketing spend is down from 3% of sales before COVID to just over 1% of sales. The consumer remains extremely healthy. We've seen no evidence that they've really had to cut prices in any way or increase discounting in any way. It seems every indication we have is that January for the consumer has started off extremely strong. And we think that's going to really benefit Darden. I mean, you've seen a couple large earnings reports from restaurants, McDonald's and Starbucks, where the U.S. comps were up 10. I think that's evidence that the consumer is very healthy in spending at restaurants right now.
Does this look like a Darden Restaurants operation that has already started recession-proofing its business? And is it recession-proof?
You know, that's a great question. They really did not comp down materially during the last recession. And I think that part of the reason for that is the fact that Olive Garden is a lower price offering than many of its peers. The never-ending pasta bowl is a great value for Olive Garden and for Darden as a whole. So they weathered the last recession relatively well. I don't think any full-service restaurant company is going to be completely immune from challenges if we get them. Generally, as a whole, full-service restaurants saw 6 to 8% negative comps during the last recession. Darden just happened to outperform materially.
Are they going to be able to hold the pricing on something like that never-ending pasta bowl, right? Or are we going to see either price increases abate or even prices go down a little bit to keep those customers coming in the door?
We have seen them increase prices. They've actually taken prices up year over year about 6%, which is less than most restaurants. Most restaurants we're seeing are taking prices up 8 to 10% right now. Darden has taken them up a little bit less than peers, but no company. I mean, the restaurant industry right now is dealing with 10 to 15% food inflation, 8 to 12% labor inflation, a quit rate that remains at 5.6% if in the most recent JOLTS survey, well above 4.5% from before COVID. So there are a lot of cost pressures in this business. Everyone's taking pricing. Darden is just taking a little bit less than peers.
Greg, we just had Kevin Hochman on, the CEO of Brinker, and they had a blowout quarter from Maggiano's. And just listening to hear you talk, Olive Garden is set up for another good quarter as well. Is just Italian food coming back in favor? Is there just something about these flavors that are working in this current environment again?
I think Italian always works. I mean, it's the big categories in this industry. Italian, steakhouses, the large players seem to find success. And I think Olive Garden is going to be right there with Maggiano's in terms of a strong sales performance in the coming quarter. We're a few points ahead of the street, and we think the top line trends are going to continue. Generally, we're thinking that restaurant sales are going to be pretty strong for the next 3 to 6 months.
These are businesses that had all invested a lot in curbside pickup to go. How has that held up from your perspective, especially given the growth in the digital ordering that many businesses have just had to layer into how they operate and how they facilitate that connection point with the consumer?
Yeah, it's a fantastic question. I think delivery is definitely going to stay higher than it ran before COVID. Off-premise generally, we are seeing some degradation in sales. I mean, Chipotle is one example where you look, last year they were 24% delivery in the quarter. And this year in the third quarter, they were 17% of sales. So there is some waning in terms of what off-premise is doing and how consumers are behaving. They are getting back to somewhat normal behaviors, but I think our expectation is that you continue to see a level, even out at a level that remains above where pre-COVID levels were.
Gregory Frankfurt.
We're going to double date. Me and Brad are double dating on Valentine's Day at Olive Garden. We're going to do it. We didn't tell you, Julie.
Hey, can I join you guys?
I'm just totally kidding.
Oh, a triple date.
There you go. I heard you were going to White Castle. White Castle's doing their Valentine's Day, Greg. I thought you were going there. It's okay.
No, maybe.
I mean, Olive Garden's great, but if my husband took me to Olive Garden for Valentine's Day, not sure how that would fly. All right, Guggenheim Senior Analyst Gregory Frankfurt, thanks so much for being here. Appreciate it. Coming up, the rival storage war is heating up. We're going to break down the details next. We got sort of a mini merger Monday here today, at least some reports about some potential deals that are going on. And we haven't had very much of that this year, right? It's still been definitely a pall on merger and acquisition activity. So let's run through some of the activity that we are seeing here. Public Storage making an unsolicited $11 billion bid for Life Storage, one of its rivals. You can see Public Storage is down 1.4% and Life Storage is up by 17% today. If you look at the year to date here, you've got it up about 25% with today's gains. And apparently Life Storage has already rejected a previous offer from the company, and it's coming out in a statement essentially saying this new offer isn't that different. So it sounds like that they are going to potentially reject it once again. Public Storage, by the way, separately announced it was boosting its dividend to $12 a share from $8, which would then sweeten its all-stock offer for life storage. So that's one that we're looking at. Number two, we're looking at Newmont Mining here, the gold mining giant, coming out and saying it's offering $17 billion to buy Newcrest Mining of Australia, which, by the way, used to be part of Newmont many, many years ago. This would be the biggest deal that we have seen thus far this year, would also be the biggest deal for Newmont in quite some time, and it would expand Newmont's copper holdings, not just gold, but also would increase its holdings in copper. You could see that those shares of Newmont are trading lower today. Newcrest shares, as you might imagine, got a boost in Australian trading about 9%. And then finally, quickly here, we're looking at Danaher as well. Bloomberg is reporting that the company has expressed interest in buying Catalent. These are both life sciences equipment manufacturers and device manufacturers. Danaher trading lower by about 1%. Catalent surging by some 34% in today's session. So a little bit of uptick here in this activity. Already we're in February here, so we'll see if we get a lot more of this kind of activity thus far, or as we go through, I should say, 2023. And coming up next, how the suspected Chinese surveillance balloon will impact U.S. China relations. We're going to speak with an expert. That's next.
Welcome back to Yahoo Finance. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. Markets are under pressure ahead of a key appearance by Fed Chief Jerome Powell on Tuesday. Right now, all three major indices are, in fact, in the red. Here's what's on tap this hour. The long arm of that Federal Reserve will dive into what the Fed's next move on interest rates may be. Showtime for Bob Iger. Disney's earnings hit this week. We have a preview. And Netflix password crackdown. A new survey points to trouble ahead for Netflix. We have the findings. Sorry, Brad, I'm going to have to make you pay for Netflix now. I know you've been using my account.
Oh, man. I was trying to change your algorithm, but I did my best. Anyway, Dow Jones Industrial Average, you're seeing that lower by about 0.5% this morning. We're about 31 minutes into trade, it looks like there. And the Dow is down by 168 points right now. 0.5% is what that translates into. The Nasdaq Composite, you're seeing that down by about the same on a percentage basis for the tech-heavy average. The S&P 500, you're also seeing that down the same on a percentage basis. All right, so that pretty boring right now in terms of all of the moves being the exact same right now. However, let's take a quick look at some of the other movers that we're tracking here on the day. First, I'll go to the Dow with those Dow components here. As you've got intraday, as we'll put that scale on for you, Apple down by about 1.5%. Some interesting price movements coming out of China. We'll get more into that in a moment here, but Apple down by about 1.5%. At this point, you've got J&J that's down by about 0.7%. Nike, interesting move there. It's down by about 2.2% as well. And so largely it seems that much of the move here for the Dow 30, you're seeing that to the downside here. And Nike with the biggest decline, as we mentioned a moment ago, will ride out with a view of the Nasdaq 100 there. And then switching gears here, back to our top story this morning, China's suspected spy balloon. Not the only casualty of the weekend. The event deflating the possibility of a trade relations thaw as the semiconductor war heats up. Joining us now, we've got Riva Goujon, who is the Rhodium Group China Corporate Advisory Director. Great to have you here with us this morning. First and foremost, when you think about the activities that transpired over the weekend and the reality of where the relations can start to gain some footing, what would you be looking for next from here?
Well, apologies in advance for any puns. This balloon gate is kind of riddled with it. But as you said, balloon gate, it needs to deflate, right? This will take some time for that to play out. You may have seen that there's another balloon that the U.S. has essentially called out China for having another balloon that's over Latin America currently. And so that may need some time to play out. I don't know if we're actually going to see another shoot down, but certainly the U.S. will want to draw attention to violations of sovereignty. But now for next steps, right, as we get over this one episode, because really when you step back, surveillance is part and parcel of great power competition. There will be missteps. And that's exactly why you need high-level dialogue to be able to manage the fallout. I do think that is something that this U.S. administration understands quite well. And so the messaging from the government so far has been, we will continue the Blinken visit. It hasn't been canceled, it's been postponed, and it will resume when, quote unquote, conditions allow. So what do those conditions look like? Well, one time, and Beijing has already expressed regret initially when it thought there was still a chance to get the Blinken visit back on track to the original plan. Now you're seeing some posturing where they're protesting the shoot down of the balloon. This will play out. It's fine. But I do think you will see the Blinken visit take place. Treasury Secretary Janet Yellen is also expected to go to Beijing. There's a lot of urgency, especially to get military-to-military dialogue back on track.
Riva, first and foremost, you never have to apologize to us for puns. We're big fans. But it seems to me, as a non-China expert, decidedly, but it seems to me that this is unusually clumsy on the part of the Chinese, something this visible, right? Are there any sort of bigger takeaways from that?
It does appear to be a misstep. I mean, obviously, the timing is terrible. Beijing did want to see this high-level visit happen. It's trying to reassure investors that, look, China is still a safe place to come in to invest. Zero COVID is over. All the messaging has been about pro-growth, pro-investment. And so when you have high-level diplomatic exchanges, that is something that's intended to boost confidence. So yeah, the timing is strange. It raises some questions about, does the right hand know what the left hand is doing? But you know, that's where, when we look at just the timing of the visit, you can understand a bit more now why the White House was deliberating whether or not to delay the visit, because shooting down the balloon while Blinken is in Beijing or en route would have made for a pretty awkward situation and honestly would have just distracted from the entire original agenda.
Riva, do you anticipate any changes to trade policy either way because of this, or it's too soon to tell?
No, I mean, again, this is part of the competitive climate. So an incident like this is not going to have a direct impact on trade, but there is a lot going on in the trade and investment climate already to be aware of. Most importantly, just seeing how U.S. policy is evolving to target China on a number of fronts where we're seeing hard-hitting export controls targeting foundational technologies, and that target list is expanding. And you're seeing a number of Chinese tech champions that are under threat from U.S. restrictions, anything from human rights to data security to military end use. These are all different grievances that the U.S. can raise to target China's tech champions at a time when it needs those companies to spur growth, to spur innovation in a time of structural weakness.
There are typically some significant moments in the past where anything that China deems perhaps that it thinks is unsafe for the public there to see on social media, it's censored. You can't find it. You can't see a video like this. This video, there are reports that you can see this very openly, and this at a time where there's already been this shift that's noted around some U.S. companies that do operate in China and that are trying to have better relations with the consumer in China as well. Does that signal anything to you when you hear that there are reports that, hey, yeah, we still see this video on social media for anybody who wants to find it at that time and in conjunction?
Yes, it's a good observation. You know, this is just raw nationalism playing out. In the United States, we saw kind of the jubilation over that incredible video of the shoot down. And then on China's side, right, you can spin this into a narrative of, well, this is, you know, the claims coming out are it's a violation of international law, which is kind of funny because this is invading U.S. sovereignty and airspace. But, you know, each side will spin its own story around this, get what it can out of the moment, and then move on. But I think there's a deeper sentiment. You are also seeing out of Chinese social media a strong desire to get that Blinken visit back on track and to get to a more stable point of U.S.-China relations. But here's the thing. When high-level visits are happening between the U.S. and China, I think, you know, a lot of the investor community looks at that with wishful thinking, saying, okay, the temperature's going down. In reality, though, these high-level interactions are about managing escalation in the competition, which is critical because you don't want it to go off the rails. You don't want to turn this into kinetic conflict, but we certainly are in an escalatory phase.
So, Riva, bottom line, are there implications for investors when it comes to Chinese stocks trading in the U.S. in terms of sort of a blanket avoid or a blanket caution, or does this particular incident not really have implications for that?
You're going to see, you know, short-term kind of market sentiment analysis. But beyond that, there are bigger issues in play where the U.S. is drawing the line on, for example, outbound investment restrictions, which is a policy emerging in the United States. And these, as National Security Advisor Jake Sullivan terms, as force multiplying technologies in semiconductors and quantum and AI. Those are the companies where if a Chinese company is touching those more sensitive areas, they are likely to be a target. And so as we see that start to bleed out further into the market, that's what I would be watching for moving forward.
Riva Gojan, Rhodium Group China Corporate Advisory Director. Good to see you this morning. Appreciate it.
Thank you.
Ahead of Disney's earnings on February 8th, we have a bullish call from Evercore ISI analyst Vijay Giant, mostly on hopes for Bob Iger-driven cost cuts. Says the analyst, we believe there is scope to increase operating income over the next several years by $1.8 billion between linear cost savings and studio course correction measures. This would translate into increased earnings of 75 cents a share and support a $125 share price for Disney. Coming up, a new CEO atop one of the world's largest private equity firms. Julie has the details and other top headlines next.
Here's a look at some of the other top stories that we are following. A powerful earthquake ripping through Turkey and Syria early today, with the death toll suspected to exceed 1,900, according to the Associated Press. The first quake, with a magnitude of 7.8, occurred before dawn. It was followed by aftershocks, some of them nearly as strong as the first. Automaker Tesla raising the price of its Model Y by up to $1,500. The electric vehicle now starts at $54,990, with higher-end models starting at $57,990. The Y is Tesla's mid-range price smaller SUV, sitting above the Model 3 but below the Model S sedan and Model Y SUV. And the pricing comes after the Biden administration modified EV tax credits to apply to more vehicles, although Tesla did not say if the price rise was in response to that announcement. And finally, private equity firm The Carlyle Group choosing Harvey Schwartz to be its next CEO, the move ending a contentious selection process for the next leader as the company tries to regain ground lost to competitors and to recover from an internal power struggle. Schwartz is a former Goldman Sachs co-president. He's set to take the job on the 15th of this month. Sas?
Lots to watch on the political front this week, from Tuesday's State of the Union to the fallout from that balloon. Joining us now with three things you need to know in D.C. this week is Yahoo Finance contributor Kevin Cirilli. Kevin, of course, we have to start with the balloon gate.
Yes, balloon gate, and all attention now putting U.S. China relations front and center for the week. I'm on Capitol Hill this morning, and I can tell you that talk amongst Republicans is whether or not to bring forward a resolution condemning President Biden's handling of the balloon and the Chinese balloon. But when I talk to Democrats, their issue with this is that perhaps the focus is being put on domestic politics and less so on the actual issue of China having this surveillance balloon fly above the United States. So this balloon gate, definitely the latest illustration in terms of Chinese surveillance, and it's pushing the issue of the U.S.-China relationship front and center, as you alluded to, President Biden's State of the Union address coming in just more than 24 hours, and also at a time in which Secretary Blinken has postponed that trip to China. Remember, last week we were talking about his travels. He will no longer be traveling to China this week as a result of that surveillance balloon.
And Kevin, you mentioned the State of the Union this week. Now China's probably going to come up during that. What else should we be looking for?
Well, from the perspective of as it relates to the business community, China will no doubt be one of the dominant themes in terms of what investors will be looking for from President Biden tomorrow. It also comes at a time in which there's been a coalition forming of Republicans and Democrats in how to address the China challenge and the China strategic competition. And so whether or not President Biden is able to thread that political needle of being a unifier as it relates to a longer-term approach to the China challenge remains to be seen. But then the other half of this speech, which will be closely watched by domestic politicians and Republicans and Democrats alike, will be whether or not he's going to run for re-election in 2024. Now, the White House is saying that President Biden is going to be hitting a series of domestic political stops following the State of the Union address. But look, I mean, we've all talked about it in the last several weeks. There have been Democrats who have been openly wondering, if not Biden, then who? And so he, as the leader of the Democratic Party, definitely needs to speak to the 2024 campaign as well. It's going to be a fascinating State of the Union address. Folks are wary about the economic footing of the United States and whether or not it's headed into a recession. And so there's a lot that President Biden has to do both domestically and internationally tomorrow night.
And Kevin, while we've got you, what about the debt ceiling talks here?
Oh, let's not forget about the debt ceiling. I mean, look, I've been talking to folks all over the last couple of days and as it relates to the debt ceiling. And, I think that McCarthy-Biden meeting at the White House last Wednesday, in which McCarthy then, following that meeting, said to conservative news outlet Fox News, Sean Hannity, that ultimately he believes he'll get President Biden to concede on making some spending cuts. Now, that signaled that ultimately, I think from the business community's perspective, that Speaker McCarthy wants to raise the debt ceiling, but he's going to need some type of concession from Democrats in order to do so. Whether or not that hurts Speaker McCarthy politically remains to be seen.
That was some vociferous exasperation there a moment ago, Kevin. I hope everything is okay. We're going to make it through this week. We got this. Yeah.
Well, I'm just excited for the Super Bowl, so.
Yes, indeed. Kevin, good to speak with you this morning. Thanks for teeing up this week. Yahoo Finance contributor Kevin Cirilli there. Coming up on the other side of this short break, the Iger effect. What to expect from Disney's first earnings report with Bob Iger back at the helm. That's next. Disney in the spotlight once again this week as investors gear up for the company's first report since Bob Iger made his return as CEO. So what should they be focused on? Yahoo Finance's Alexandra Canal joins us now. Allie, what are you going to be watching for?
I'm watching for a lot of things. This is an exciting time, as you mentioned, Bob Iger's first earnings report since that surprise return in November. And since then, there have been a lot of changes. So I do think it's important to take a second to look back to see what Iger has changed at the company in that short amount of time. Number one was the fact that he immediately restructured Disney's entertainment and media division, otherwise known as DMED, in addition to firing Kareem Daniels, who was a top streaming executive at the time. And all of this was one of Chapek's first big swings. And basically the very first day that Iger stepped back into that CEO position, he undid it all. So I think on this earnings call, investors will want a little bit more clarity when it comes to Iger's plans on managing Disney's various content pipelines and how that all feeds into Disney's various streaming services, which include Disney Plus, Hulu, and ESPN. Another major change that we saw was when it comes to that new hybrid work mandate, Iger mandating that employees be in the office 4 days a week. He is very focused on creativity, and it seems like during the Chapek era, we lost a bit of that camaraderie, of that togetherness, and this seems to be paramount for Iger with culture. So even though employees are not too happy about that, There have been rumors that they're going to protest that 4-day mandate. That's something that Iger immediately wanted to see happen. And then finally, another major change that we saw recently was adjustments to the park pricing. The ballooning prices at the parks, they've been heavily criticized by a lot of Disney fans, Disney consumers, and even Iger himself admitted that he was surprised to see a lot of those increases. And although Iger didn't necessarily roll those back, we have seen more incentives for those premium members, like free parking at Disney resorts, along with free photos at the parks. And the parks, they continue to remain a very important part of Disney's bottom line. And we did see that miss on revenue within the parks division last quarter. So that's something to keep an eye on, but really lots to track in this earnings report.
Yeah, and then there's one change that Iger didn't make that maybe he's being pushed to make, and that has to do with the board of the company and Nelson Peltz's activist campaign against it. Are we expected to get any kind of commentary about that on the call?
I would be surprised if Iger chose to address this. Obviously, we've heard from both sides over the past few weeks, statements from Peltz, statements from Disney. I don't think we're going to get anything on this call. However, I do think there's other things that Iger needs to address. Number one being the cost cutting and layoffs that Disney has sort of teased. We haven't gotten any concrete news on that. So I think that's something that they'll have to address. Also, the declining television business. How do they plan to handle that? And then on those Disney Plus targets for profitability and subscribers, the street has been a little lukewarm on that. The previous target said Disney Plus would turn a profit by next October, reaching subscribers between 215 million and 245 million by 2024. And Disney Plus currently only has about 164 million worldwide subscribers. So there is a little bit of an expectation that Iger could address those targets for Disney Plus. So, I think what Iger chooses to address and the tone that he chooses to go with on this call, that's going to be paramount for investors and the stock reaction.
All right, Yahoo Finance's Ali Canal going to be tracking that, and you're going to be on the call as well. Ali, appreciate it. And let's continue this conversation with Disney earnings on tap. Our next guest looking ahead to Bob Iger's second act with a priority of doubling down on profitability as the number one priority there. Macquarie Senior Media Tech Analyst Tim Nolan joins us now. Tim, great to have you here with us this morning. How much of what has been said in the latest activist campaign towards Disney do you think is lighting a fire under the management team there?
Well, first of all, thanks for having me back again. I think it's addressing issues that investors have been concerned about for some time, mainly really just about getting back into a more profitable outlook. The direct-to-consumer investments have been so heavy, bringing that business down to losses of $4 billion or so last year. That I think investors, not just in Disney, but in terms of other streaming services, all are losing money. And so what used to be an atmosphere of looking for subscriber growth now over the last 12 months has shifted very firmly into an atmosphere of looking for earnings growth. And Disney, I think, fortunately, is in the right spot now. I think timing may be on its side here, where it should be on an upward path into better profitability. Let's say getting to profitability, as you mentioned in the last segment, by fiscal 24. So like 6 quarters or so from now, Disney aims to have its DTC, direct-to-consumer businesses in profitability. If they demonstrate in the quarter that they're moving in that direction now already, which I think they will, then I think they've got a little bit of tailwind. So I'm not sure what the activist proposal is, or what how they expect Disney to do things better than what Iger basically has a mandate to come and do already.
But Tim, wouldn't Nelson Peltz on Disney board just speed up that sense of urgency, perhaps?
I don't know. I think there's probably an urgency on the board here. Look, they made a major CEO change, going back to Bob Iger just a couple of months ago. That's a pretty dramatic move. And of course, part of the concept there is to get a permanent successor coming after him, supposedly in 2 years' time. So I don't know, having one activist investor voice on the board necessarily accelerates the board's urgency to get things done. I think it's pretty clear what Disney wants to do, what investors are pushing it to do in general, and what I think it will move towards.
In terms of what it will move towards and what investors wanted to do, one of the outstanding items has to do with ESPN. So I wonder what you think strategically is going to happen on that front, and if any changes are coming, when they might happen.
For sure. Well, ESPN, we've written recently, we think this may be the most important issue for Bob Iger to deal with in his tenure now. I think goal number one, as I just said, is getting direct to consumer toward a more profitable, sustainable path. Goal number two, which is, really an extension of that, I think is getting ESPN decided. What are they going to do with it? There's been pressure on Disney to potentially divest ESPN. We've heard that from several sides. I don't think that's what Disney wants to do. I think Disney sees a future for ESPN in streaming. And we believe actually the next stepping stone toward getting there could be the new NBA rights contract, which is up for renewal after the 2025 season, I believe. Now, these rights usually start to get negotiated as much as 2 to 3 years in advance. That's what the NFL did already a couple of years ago, ahead of its rights renewal starting this coming fall. So if the NBA contract is being discussed this year, I'm quite sure that will include a lot of streaming capabilities within that. Remember, the two main holders of this, the two holders of the NBA rights are ESPN and Warner Brothers Discovery's Turner Networks. Both of these companies have vibrant streaming businesses. Disney's been doing a lot of work with ESPN for many years with ESPN Plus, but it's still not a completely over-the-top service. The NBA rights could be a more important stepping stone to work more streaming into that, and we'll see if there's eventually, I don't think right away this year, but within a couple of years, maybe we have more of a clear plan as to ESPN becoming a fully over-the-top streaming service. I think that is Bob Iger's main legacy from this time around.
Even beyond sports, do you believe that there's the opportunity, or at least based on the Bloomberg report, the likelihood that we might see Disney try to tap an old strategy that they had in licensing some of their content to other streaming platforms?
Yeah. Part of the goal of getting into better profitability, of course, is both reducing costs, which is where I think Disney will be focusing now, whether it's staff reductions, whether it's more operating efficiencies, whether it's just less content investment step-ups. And now the other side, of course, of that is driving better revenues. And so as Disney over the last 3 years has just been plowing, content resources into Disney Plus and into Hulu, maybe there's a bit more of an effort now into sort of how can we make more revenue, more money off of this. One is the ad tier that we see coming out of Disney Plus now for a couple of months. Very much looking forward to commentary on that on the call this week. And then, two would be just, what other ways can they drive revenues? One may be if there's more licensing of content to be done, whether it's the old-fashioned way back out to TV network groups, whether it's selling it to other streaming services, some of these fast services. So I think Disney will certainly be looking at that lever to pull as well.
Tim Nolan, Macquarie, Senior Media Tech Analyst. Good to see you. Good luck on the earnings day this week.
Thank you.
Coming up, we'll be right back with some things you need to know for the week ahead. Don't go anywhere. Fed Chair Jerome Powell gears up to speak at the Economic Club of Washington tomorrow. Investors very keen on what Powell will have to say after January's blowout jobs report. Here on what we might hear from Jerome Powell is Yahoo Finance's Alexandra Semenova. Alexandra.
Well, guys, this week is all about Jay Powell. We have a lean economic calendar. We have a medley of earnings from companies like Walt Disney, Pepsi, Uber, PayPal, and some others. But for markets, it's all about what Powell says tomorrow at the Economic Club of Washington, D.C., where he's scheduled to speak around noon. Bank of America's Michael Gappin put it well in a note last week. He said the key question for markets is whether Powell's dovishness after that FOMC meeting last week was intentional or accidental. We did get the Fed saying that more rate hikes are ahead, but investors seem to eat up Powell suggesting that we have disinflation in the economy. It was risk on immediately after that speech, and it's not actually clear whether he meant to sound as dovish as he did. Tomorrow will really be an opportunity for him to reassert his hawkishness, reassert his position that the Fed is still going to keep hiking. It's going to keep rates higher for longer. He's going to be interviewed by the Carlyle Group's David Rubenstein. Should be a really interesting conversation, and you better believe that that speech is going to be under a lot of scrutiny. Investors will be listening to every word he says, listening to his tone.
Yeah, most definitely. And trying to figure out if they should still keep buying stocks, as we've seen happening thus far this year. A lot of strategist commentary out about whether the rally is going to keep going, right?
Exactly. You know, we've been on an uptrend to start 2023. Investors are betting that the Fed will pause and even cut rates this year as they see inflation come down from highs, as they see some slowdowns in housing and manufacturing. But there's a lot of indication that this rally is premature. We had that jobs report last week, 517,000 payrolls, keeping the upside risk to inflation high. Yes, it's off of its peak of the cycle at 9%, but it's still 6%. You know, inflation is still persistent. There's still the possibility of a recession. There's not much ground to this rally. I was in Miami last week for the Global Alts Conference, and the panelists did not share the optimism around stocks that we're seeing in the market. Mike Wilson on the stage said that this was purely the January effect taking place, that we're going to see the S&P 500 go down to about 3,200. And then legendary short seller Jim Chanos made a really interesting point. He said that once you see meme stocks rally, he called it the garbage, his words, not mine. That's usually an indication of the end of the rally, not the beginning. And we're seeing that right now. Carvana up 200%, Peloton up 90%, the Arc Innovation having its best month since 2020. So not much ground for this rally.
Abnormal moves indeed. Alexander Semenova, appreciate it. All right, inflation is slowing down, fueled by decreasing gas prices and an easing supply chain. But what does this mean for recession chances? Let's bring in James Galbraith, University of Texas at Austin, professor of government. Good to see you here this morning. So we've been talking about all week long, going back to last week after that Fed presser, the concept of disinflation. In what you study, do you see disinflation in various parts of the economy?
Well, it's clear inflation has been slowing since last July. This is not a new thing. It's now a well-established 6-month phenomenon. And indeed, the Fed's own staff basically predicted this well over a year ago. So the Fed is now in a bit of a box. They bought into the story that inflation was going to be persistent. It hasn't been. They could claim victory, but that would basically show that they were wrong in the analysis that they committed to at the start of last year. So the most likely thing is that they will be persistent in the policy that they're now locked into, even though the economic conditions no longer justify it.
Professor, you've done some interesting research on the sort of bias of the Fed at what is supposed to be, of course, an independent organization. So how does that feed into what you're talking about, the fact that they'll stick to their guns, even if perhaps the evidence would push them in a different direction?
Well, the Fed is independent of the executive branch. It's not an apolitical organization. People who are appointed to it have political affiliations. Typically, Republican chairs are reappointed by Democratic presidents. And the result of that is they tend to be quite a bit tougher on Democratic administrations than on Republican ones. I don't think we're necessarily seeing that yet because we're not quite yet in the presidential reelection year. But that is something to bear in mind looking forward.
Okay, and so once we do kind of enter into the throes of the political cycle all over again, you're going to have an economy that at what point, who really knows exactly the extent of the Fed's policy that has been fully ingested by the economy, and at what point we could see even more of a shift there? What's the timeline that you would be tracking as we get on later into that political cycle?
Well, I think we have to wait and see what happens this year. The Fed is locked into an inverted yield curve, which is typically an indicator of trouble. They are, as your reporter just said, that they haven't been anticipating a very strong jobs reports, which are not bad news. In fact, it's excellent news. There's no wage pressure. Wages have not increased above the rate at which prices have been increasing. So all of that is not a reason for a tight policy, but can they back off from a tight policy under these, given the way that Chairman Powell has said that the wages are his concern, tight labor markets and so forth? I don't think they're in a position to back down. So we shall see over the course of the year whether the strong job situation comes to an end, and then we'll have to take it from there.
So when all is said and done here, do you think that we will indeed enter a recession? The sort of hopes for a soft landing seemed to be springing up last week, it felt like. But is that a realistic scenario?
Well, I'm going to avoid forecasting since it's a way of making oneself look foolish. But there's no history of soft landings in consequence of a tight monetary policy. They always just go on and on until the households can no longer absorb new debt, and then there is a financial crisis. That's the way these things end, unless the Fed decides to back off. But as I say, I think they're basically in a box where they can't do that.
Okay, so forecasting aside, do you believe that there are parts of the consumer situation right now that are already feeling the effects of a recession?
Oh, sure. I mean, the construction sector has already been hit hard. As you can see, the stock market's been hit. Cryptocurrency's been hit, for what that's worth. But the construction sector is the big one, and you can see that housing starts are down. And that is a consequence in part of the tight monetary policy that we're already seeing.
Professor, thank you so much. James Galbraith, the University of Texas at Austin.
My
Professor,
pleasure.
Appreciate it. Coming up, Netflix is cracking down on password sharing. Sas got a take on that next. Netflix is preparing to crack down on account sharing sometime in March as it seeks to boost sagging profits. But the crackdown could trigger an exodus of users from the platform. That's according to a new survey from Jefferies. Saz has got to take. Saz, already on social media, I have seen a lot of complaining about this pending policy.
Yeah, and this is the day of reckoning for many Netflix users. Those years of sharing your passwords or scrubbing off passwords off of friends and family are done, or likely done sometime in March. The precise date unclear, but a good survey out of the team over at Jefferies, Andrew Urquhart, who follows this company. First chart here we have on the board, he surveyed current Netflix users. 62% of them say they will stop using Netflix once that password sharing ends. That is a major red flag. Now, of course, you never know what consumers will actually do. Maybe they are, in fact, hooked on Netflix, and maybe that is a lower percentage. Who knows? But still, that is a jarring number there that does not suggest good things ahead for Netflix. Next up here, we're looking at why they would stop using Netflix. And the number one response here, they can replace Netflix with other services. Followed behind that is they don't enjoy the content enough to pay for, which is, I actually found that very surprising. But there is a lot of content on there. Maybe it's just not as high quality as it needs to be to get people to pay. And the next one here, what streaming service would they use after they get off of Netflix? And the top response there is Amazon.
Wow, that's surprising.
Prime. And the only reason I could think here, guys, and I'd love to get your take on this one, maybe you're just, for $15 a month, you're just getting a lot more. You have Prime delivery service in addition to video. Maybe they see a greater value in that. Just also, too, not a lot of value, I guess, seen in Apple TV Plus. That has just been, I think, a lot of analysts have been talking about that. Apple just needing more content on there. And then Hulu, probably the lower price service on there as well, may pick up some of those Netflix users. But this was something that Netflix new co-CEO Greg Peters talked about on the fourth quarter earnings call a couple weeks ago. He's saying, quote, "This will not be a universally popular move, so there will be current members that are unhappy with this move. We'll see a bit of a cancel reaction to that. We think this is as similar to what we see when we raise prices." So Netflix is bracing for a potential a lot of users fleeing the platform. I don't think maybe Wall Street analysts have modeled for this correctly. That's just my take, but we will find out. Ultimately, my take is this: you can't fault Netflix for wanting to get paid. And yeah, I guess I'm signing with big corporate on this one, but here's a company that is actively looking for ways to juice up earnings growth, get that earnings growth reaccelerated. And one way to do it is weed out the freeloaders on the platform. I'm not saying it's good, it hurts consumers, I guess, but this is a public company trying to make money.
Well, yeah, they say, and of course in the entertainment business, content is king, but also when you're making that content, cash is king too.
You have to get paid.
And so with the increased amount of spending that they've had to do over the past 7 years, I'll kind of round it out to part of that when they were expanding more internationally, and then with the roll-off of some of the Disney assets to try and backfill for exactly where those titles needed to be able to attract more users. Yeah, it means a great deal when they're finding themselves on stages winning awards for some of that content, but is it enough to drive people to say, you know what, yeah, I'll pay up even more for that, especially when they say to themselves, to your point a moment ago, what if this is going to get me a discount on my groceries? And I'm not convinced, clearly, but as the Amazon
holdout
that I am, yeah. So thank you for putting it that way. But yeah, at the end of the day, I think pricing right now is going to be looked across for all of these households when about 3 to 4 accounts is what people usually hold on to.
Here's the thing. Can we bring back that first graphic that showed what people are going to do in response to this? If we can bring that back. Because
bring it back.
So here's the thing. Stop using Netflix. They're not paying for it anyway. So if you look at the net loss, net loss to Netflix, there isn't a net loss unless the people who are sharing their password are going to cancel. There doesn't seem to be any indication of that. So if even a fraction, even if 16% of those people who are paying nothing right now start paying something, and it's in fact more than 16% because there are other people who are going to get the ad-supported tiers, then that's incremental revenue for Netflix.
We embrace here at Yahoo Finance all Netflix users that are leaving the platform consume our content all day long. Please, it's out there.
And if you're
sharing, you won't have to pay anything.
You won't have to pay anything. Please come over to our site and click on our videos.
Coming up, everyone, iPhone 14s are reportedly getting a discount in China. We're going to discuss that next. Welcome back. You hear the music, you know what time it is. It's time for Cover Time. 3 stories, 1 minute each. We start with this today. Apple, latest iPhone, the 14, it's reportedly being sold for a discount in China, according to China Securities Journal. JD.com offering the device at a rate 800 yuan or $118 below Apple's normal price. Now, retailers in Shenzhen have also reportedly begun reducing prices. I believe this is on the highest tier iPhone 14 as well. So that particularly noteworthy because Apple does not have a history of allowing discounting of its products.
Yeah, definitely. So is this a warning sign, a continuing warning sign? You saw those Apple shares down at 1.5%. Unclear, right? Because even as you pointed out earlier, Saz, even after the earnings report that showed there was some concern maybe about demand, you know, the shares kind of shrugged it off and looked forward. So are we going to see investors continue to look past some of these?
And you can read more of that, what Julie's mentioning in today's morning brief on the Yahoo Finance homepage. But look, I think it shows that maybe Apple needs that real game-changing product here, and maybe these phones just weren't it in terms of a hardware design.
Phone? Do they need a foldable phone?
They need a foldable phone, Brad. You heard it first. All right, Bill Gates is not a fan of space trip funding when a reporter from BBC asked the Microsoft founder what he thinks about leaders like Elon Musk investing millions in space travel. He stated there were other more important issues to focus on. Historically, these two really do not like each other. They've traded jabs in various media outlets and also, I believe, on Twitter as well. But look, Bill Gates, incredible philanthropist. I think he ultimately just wants to see Elon Musk doing more. Doesn't have to necessarily follow down his path, but just wants to see him giving something back.
Well, also the fact that he's been buying up a ton of farmland on Earth here, too. So he's really hoping that this Earth thing goes well for us in the near-term future.
I also hope this Earth thing goes well for us. I hope that we don't have to flee to Mars. I mean, I think Gates is making a good point here, right? Course, let's improve the planet that we're on before we give up on it and say we're going to have to go to Mars in 50 years.
I hear Olive Gardens opening on Mars, Julie. I'm very excited about that. I'm pumped.
That's not going to change my mind about wanting to go.
All right, fine.
Space pasta, not in the cards for me. Thank you.
You squeeze it out, yeah.
Hollywood rolling out the red carpet for the music industry's biggest night last night, the Grammys, of course. Beyonce made history as the most decorated Grammy winner of all time, but the coveted Album of the Year award went home with Harry Styles, and there was actually a lot of criticism that Beyonce didn't get that particular award. I don't have strong feelings either way.
Oh, I do.
Okay, go for it. Tell
Renaissance is an album of our lifetimes, quite frankly. And for it to be in a category, and yes, there were some amazing performances, awards given out. This was actually a really great year for music, all in. You saw the emergence of some new artists that I think are also going to be the ones who are the bearers, the standard bearers, and kind of receive the baton in this new age of digital consumption of music, but then are also championing everything from women's rights to LGBTQ rights and really using their platform and their music to pioneer and make sure that they're advancing culture. And so Beyonce has been one of those standard bearers for a long time, and she's inspired everybody, including Lizzo, who won her own won her own for Record of the Year last night.
Exactly. Yeah. All right. Well, I'm glad that you had strong feelings.
I do. Renaissance is that's one of my go-to
we know. It's. I think if we if there was a Spotify rewind or
Apple Music
over here
for our pre-show music, I think "Break My Soul" is
but
the
Brian
one that
plays
has been played
all the time.
That's Brian.
I want to say this. I really enjoyed Harry Styles' outfit. I just have to get it. I looked like a bedazzled wetsuit. I really dug it. Good for him.
I thought it was more of a Harlequin situation.
Really?
It's kind of like the streamers that you put up when people are coming over for a party.
I'd love to wear it on one time from the show. I'd love it.
I would also love that.
Done. Sign up.
I think we would break some.
You won't break my soul.
Let us launch a subscription program before that, so they have to buy in to see that happen.
Okay.
Yes, I think
Let's
that's
monetize this.
Maybe we can do some sort of auction, charity auction, to have Saz wear that outfit.
I would love it.
We're gonna start the poll
I'm ready
right
to help.
now.
And if you win the auction, I come with 10 stock picks in that outfit. There we go.
Let's take a look. Speaking of stock picks, let's take a look at markets before we leave you. We do have stocks remaining lower here as investors seemingly brace themselves for Jay Powell's comments tomorrow. But one of the other things that we continue to be watching here is what is happening with the AI universe, if you will. Still, if you look at the top trending stocks on our site, C3.ai is number one. We have something called Big Bear AI that's on there. We have SoundHound on there. All of these are AI-related plays, and we continue to see money come into these.
Yeah, I mean, I just think back to some of the earnings calls that we've been listening to over the past few weeks, whether it's Microsoft, whether it's Amazon, any cloud-touching company has tried to say something on the call about what they're doing within artificial intelligence and how that's going to be layered in either on the cybersecurity front or just making processes easier there. So that's something to continue to do, kind of a hotkey or a Command F for the Apple MacBook users out there over the course of the rest of this earnings season.
I will just say this. If you are on a trading platform buying C3i, Big Bear, you name those names Julie just mentioned, ask yourself this in the mirror. Do you truly know what these companies do? And if you don't, just stop playing these names. I'm sure they might do AI, they might not, but just know what these companies are doing.
Here's the great thing about what ChatGPT has done is it's put AI into the mainframe of people actually knowing or experiencing a delta. Whereas blockchain, yeah, we all knew that companies were investing in it, and some of them, quite frankly, weren't Long Island blockchain. So at the end of the day, it's a difference in how is this impacting my life on a day in, day out basis? What are the potential use cases that I see for it, and how am I immediately benefiting from it right now? And then seeing some of the major companies that we talk about in the equity markets on a daily basis saying that they're going to be investing more on it as well, and what that can mean for their lives too.
We'll see what ends up happening, if this stuff has legs and if they do that research. Coming up, Rochelle Cuvo is going to speak with the CFO of Visa for the latest pulse check on the payment space. Don't miss that. Stay tuned.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Cuvo. Here's a look at what I'm watching this morning. Equities feeling the Monday blues as attention turns to a speech from Jay Powell, who takes stock at the halfway point for results season and asks the question, are we in an earnings recession? Well, from Amazon to Google, it seems like big tech wants a bigger and bigger piece of the healthcare pie. We'll speak with an expert on how science fiction is fast becoming science fact. And splashing the cash. How much are we spending and where's the money going? From travel to crypto, we speak with Visa's CFO this hour on the trends you need to know about. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. Of course, awaiting word from Jay Powell, a bit of jitteriness here in the markets, but still off the session lows. The Dow there down about 1/3%, they're down 115 points. Taking a look at the S&P 500 there, down more than 0.5% on the day. And the tech-heavy Nasdaq, also digesting earnings season, of course, they're down 83 points on the day. Let's also check in on the Treasury market, as any notes that we get from the Fed are always reflected there. We're seeing all three in positive territory there. Look at the 5-year, they're up almost 3.25%, the 10-year up 2.25%, and the 30-year just shy of being 1% up. Well, of course, there's lots for investors to keep an eye on as we begin this new trading week. Now, here's some of the top things to keep watch of. So, of course, Fed Chair Jay Powell is gearing up to speak at the Economic Club of Washington. That's happening tomorrow. Now, this comes days after January's blowout jobs report, just as the employment picture began to show some signs of moderation. And investors will, of course, be eager to hear Powell's remarks as investor optimism dims on a possible pause in rate hikes. Still possible. And of course, staying in D.C., President Biden prepares to give his State of the Union address, giving a glimpse at how he plans to push forward his legislative priorities amid a new Congress. And the speech also comes as Washington works on getting a handle on the debt ceiling, with U.S. China relations also likely to be topics of note. It's following the fallout from the downing of an alleged Chinese spy balloon. And of course, on the earnings front, Disney gears up to report quarterly results this week. All eyes will be on Bob Iger, as this will be the first report since his return as Disney's CEO. Now, shares of the media giant have climbed roughly 25% so far this year. We'll see if the company will be able to keep this momentum, or if this week's earning results will send shares tumbling, as performance of parks and streaming will, of course, be back in the spotlight. All right, well, now let's get to Yahoo Finance's Ines Ferrer on the market action as investors look ahead to this busy week indeed, Inez.
Yeah, that's right, Rochelle. And we are seeing weakness with stocks today, but we are off the lows of the session from earlier this morning. So just take a look at our S&P 500. It's down about 0.5%, but it was down as much as 1% earlier this morning. Do want to point out what's been happening with the U.S. dollar index, because we've been watching that and that inverse relation that we've seen. As the dollar index goes up, you're seeing weakness when it comes to risk assets. So the dollar index up about 103.61, and we are seeing that weakness when it comes to the stock market right now. Over on the sectors, we're watching communication services and energy stocks, which are leading to the downside. Consumer staples is really the only sector that is in the green right now. And over on the Nasdaq 100, do want to point out Tesla up 2.5%, defying the market weakness today. Part of this has to do with the EV maker raising its prices on the Model Y in the U.S. This, by the way, is the 5th straight day of gains for Tesla. Also checking out the Chinese ADRs. We have been seeing a lot of weakness with these Chinese ADRs after that Chinese balloon flying over U.S. territory was shot down by the U.S. So we are seeing a lot of weakness with these stocks. Also looking at the trending tickers, I want to point out the trending tickers that are today trending on Yahoo Finance's homepage. Some of these have to do with AI, and we have seen this rally when it comes to C3.ai, up 10% today. Take a look. Year to date, it's up 155%. I wrote a piece on this for Yahoo Finance about these AI-related stocks and the popularity that we saw with ChatGPT of OpenAI. Well, that is giving a boost to other AI-related stocks like BigBear.ai as well. And then finally, just noting what's happening with RH, Restoration Hardware, down 7.4%. This is after the luxury home furnishing retailer says it now sees full year 2022 revenue growth at the lower end of its range, also saying that it's correcting some accounting errors from 2022 statements. So we're seeing pressure on that stock, Rochelle.
Certainly a lot for markets to digest at the moment. Thank you for that update. Ines Ferrer there for us. Well, one trend that we're watching is big tech's push into that healthcare space. Big name players such as Alphabet, Amazon, Apple, and Microsoft all making their way into the sector. Now, Amazon being the most recent to make moves with the launch of its prescription drug discount program, RX Pass. Now, the service is available to Prime members for a price tag of $5 a month to access over 50 shippable prescription medications. Now, this as Amazon faces off against Alphabet and Microsoft in the race to control the healthcare cloud market, while Apple looks to build out its health division as well. Now, of course, 2022 saw a number of major non-healthcare players, such as Amazon, stepping in as primary care providers. So how will the landscape shift in the years to come? Here to discuss is Dr. Bertalan Meshko, Director of the Medical Futurist Institute. Good to see you. So a lot of people have been seeing these sort of incremental moves that big tech has been making into this space. But you say in your newsletter that you don't expect big tech to take over the entire industry, but they will profoundly change the landscape. How so?
Absolutely. Thank you for having me. I think it has been quite exciting to watch how technology giants are trying to get into the healthcare business, because let's be clear, healthcare has been becoming more and more technology dependent. Not just it's almost impossible practically today to practice medicine without the use of advanced technologies, but even consumers, millions of patients worldwide started using a range of technologies, from wearable health sensors to portable diagnostic devices, remote care platforms, at-home lab tests, and I'm not even talking about artificial intelligence-based tools yet. So it's understandable that technology companies want to get into the healthcare business, but for many years, it just seemed that they wanted to contribute to the delivery of healthcare to the practice of medicine by bringing technological products to the market that they have quite good track record at producing. But now it seems they want to provide healthcare, and it's absolutely different. Providing healthcare, the lives of patients are at stake. There are really strict, really strong regulations. It requires a lot of expertise and huge amounts of money to get into the healthcare business by being able to bring those products into the market while also proving that those products are safe and efficient.
So then what are some of the ways that you're seeing? I know we've talked about primary care physicians as a way in. What are some of the ways you think big tech is going to start making more of its foray or expand in this space?
It seems that every tech company is interested in those fields where they have maybe the strongest features. Like Microsoft is really good at cloud computing. So when it comes to electronic medical records, they have a good chance for diving into that part. Even the parent company of TikTok called ByteDance just purchased one of the largest hospital chains in China. And it means that it seems that they want to provide healthcare in that country for now. Amazon is great at their global digital supply chain, so they focus on pharmacies, and that's why they have made those acquisitions. Google is amazing at doing research in artificial intelligence, so now they started publishing research papers about how to use their AI-based tools for drug design or diagnostics or supporting medical decision-making. So they focus on what makes them individually unique technology companies.
And of course, we have to talk AI, especially when we talk about generative AI as well. A lot of people talk about ChatGPT and some of those same style of technology. How do you see the opportunities and pitfalls, though, that come with introducing this sort of technology?
I think it's simple to say that it's almost endless. Of course, it's a bit more complicated than that. But what the introduction of ChatGPT meant to the healthcare community was, I think it meant a breakthrough, that finally AI is not just for researchers or inventors working in developmental silos, but it's for everyone. And I think thousands of physicians started using ChatGPT for getting ideas about how to solve certain healthcare-based problems. I know for a fact that some pharma company researchers started using that to get some meaningful outcome of the huge amounts of data they are able to use while trying to find new drug targets that could get into clinical trials. And of course, ChatGPT is not a tool, as even described by the company releasing that OpenAI, that could be used for such purposes, but we can use tools like that to get a new idea, to get a sense of the data that we have been analyzing for so long. And I think that's just one point. The breakthrough technology was ChatGPT, but what comes next would be a range of other ideas, using AI for drug repurposing, using AI for finding drug targets in shorter and less expensive clinical trials, using AI-based tools to support medical decision-making. Just imagine that in oncology, how amazing it would be to get access to a huge amounts of studies without physicians reading all of them, but get the right amount of pieces of information from each study so they can make better decisions about individual patients' treatment plans. These are just 4 or 5 examples out of the, I think, dozens that are on the market today. And if what we need for that to be able to really implement this breakthrough technology is a conscious way of adopting it, knowing the dangers, but knowing enough about what it's capable of doing, what it's capable of in terms of scientific understanding, that we could bring these AI-based products to the market as soon as possible, because regulators finally understand how to regulate a technology that's really challenging and competitive right now.
And I want to talk about this space because on one hand, you're going to have the regulators, you have existing healthcare professionals who perhaps, might not be on board with this. How is the medical community reacting to this? And what eye are regulators having on this space?
Well, the first question every physician asks these days is whether AI can replace me in my job. And I think why that's a fair question to ask from the cultural standpoint. Technologically, it has no ground because AI is not capable of replacing physicians. AI is amazing at doing repetitive and or database tasks, but everything else from empathy to creativity, intuition, compassion, all these things, I think all these tasks will be done by human physicians even decades from now. However, we know how unsustainable healthcare has been becoming over the last 1-2 decades. And we also know that it's almost impossible to check all the data, the clinical trials, the studies, the information, getting into the eyesight of physicians. Therefore, I think we very much need the help and support from automation. And for that, medical associations like the American Medical Association have been publishing reports and guidelines about the explainable AI phenomenon, meaning this is the package of knowledge you as a physician need to know about this amazing technology, the definitions, the levels, the dangers, all these. So these associations have been trying to do their job by preparing the healthcare workforce. But as you mentioned, policymakers and regulators have an even, maybe if I can say, a harder job to do here, because regulating a medical technology like before, a new ultrasound device, it was one thing. We had a good framework for that. The regulators understood the safety implications, the efficiency of that particular technology, and they could make a decision, a conscious one, whether releasing to the public or not. But now when it comes to the so-called adaptive artificial intelligence-based algorithms, that's a different scenario. Because even if you approve a technological product today, that algorithm will start making decisions from tomorrow. And with every single decision, the algorithm will change. That's the whole essence of machine learning-based methods. So how do you regulate a technology that will change with its use even thousands of times every single day? I think that's the regulatory challenge of the 21st century.
That's tough. I mean, we already see regulators trying to keep up with technology, but one that can sort of self-evolve, a whole different ballgame indeed. Fantastic stuff there. Dr. Bertalan Meshko there, Director of the Medical Futures Institute. Thank you for joining me this morning.
Thank you.
All right, well, shifting gears, 2 shares of Activision Blizzard feeling the pressure as the company gears up to report earnings after the bell today. Now, its game portfolio of popular franchises is expected to provide a bit of a lift for the gaming company. However, intensifying competition is expected to hinder Activision's top-line number in the fourth quarter. Now, this all comes as the Microsoft-Activision tie-up remains pending after formally receiving a letter of objections from the EU. So we'll have to keep an eye on how it all shakes out. All right, stay with us. Coming up, taking stock. With 50% of S&P companies having reported, it's halftime for results season. We ask how recessionary it's all feeling next. Traders may have taken profits after the stock market's heated start to the year, but as earnings results continue, companies are increasingly citing inflation, supply chain disruptions, and other headwinds. Well, as we get halfway through results season, let's take a look at where corporate profits stand thus far and what they can tell us about the likelihood of a recession. For that, let's get to Yahoo Finance's Jared Blakely. Hey, Jared.
Hey, Rochelle, you said the R word, so let's dig into that. We're talking about an earnings recession. Now, we have been talking about a general economic recession in the United States, but it usually begins with an earnings recession first, and then an industrial recession, and then an economy-wide recession. And I'll get into the details of what differentiates those three. First, are we heading for an earnings recession with respect to stocks? And this is tracking the S&P 500 EPS. And 1 year ago, for the first quarter of 2022, we had an EPS in the S&P 500 of, I believe, 225.6, thereabouts. And we're coming in this year so far at about 221. So that's why we are seeing a little bit of negative growth in EPS. So you compare this to what we saw during the pandemic, what we saw during the global financial crisis, the dot-com boom, even the recession, the general economic recession of 1991, we still have not really eclipsed those downward levels. Now, what this is very similar to so far is what happened in 2015 and 2016. That's when we had an earnings recession in the U.S., while the rest of the world developed into a general recession in their economies, most of the world anyway. And here in the U.S., we almost had a bear market. Now, we didn't hit quite the 20% down mark, and this was 2015, 2016, but we came very close. And so a lot of people who rely on that definition of a bull market being down 20% miss this right here. But the price action was very much like a bear market. Now, when we have a bear market without a recession, a lot of times it tends to be shallower and not as long lasting. And so in the U.S., we didn't quite get down to 20%, but that was pretty much the end of it. And it was rather short-lived. So nice to think that that could happen this time. Now, what we would want to see, this is one quarter, and probably in the bag that we're going to have that negative earnings growth in the S&P 500 for this quarter. What happens next quarter is going to be telling. It's possible that we fall off a cliff and that we start generating some downward bars that look more like this. Doesn't have to happen that way, but we're going to be on alert for that, because if we start getting those, going to be much more likely that we develop into a general economy-wide recession. Now, it's important to point out that the United States is a huge place, and we can have relative prosperity in one place and relative non-prosperity in another. But let me just show you how this is playing out in the labor market. I prepared these slides a couple weeks ago to demonstrate something else, but I think it's very relevant to the topic at hand. Job losses surrounding recessions. This is where we feel them first. Startups in high growth, but then in manufacturing, construction, and wholesale trade. That's the industrial side of the economy for the most part, and that's where we're seeing some weakness right here. So if we see these job losses accelerating, and we're not seeing that. Friday, these jobs were very strong. So if we see these accelerating to the downside, probably concurrent with some negative EPS in the second quarter, and maybe a general-wide economy recession later on in the year. But so far, we're not seeing that. And so far, we're just looking at this one little negative bar right here. So maybe not the evidence we need to get too worked up for in the meantime. Rochelle.
It's always tough when we get that one data point and you wonder how much to put into it. But interesting perspective there as we look at historically what that has meant for the economy. Great stuff there, Jared Blakely, there for us. All right, well, labor data shattered analyst estimates last week, with the U.S. adding over 517,000 jobs in January. Still, companies are finding it tough to hire due to the availability of jobs for those seeking work. Well, could that tightness in the labor market increase the odds of another rate hike by the Fed? For more on the central bank outlook, let's get to MJP Wealth Advisors President Brian Vendig. Thank you for joining me, Brian. So obviously, markets having to digest a lot, but you don't think that the Fed will start cutting rates this year with the labor market as tight as it is. What do you think the markets are perhaps not pricing in correctly at the moment?
Thank you, Rochelle. Great question. I think right now there's a fundamental disconnect in the expectation of when the Fed is going to ease back on raising interest rates versus market expectations. And I think the Fed has let us know that they went from a position of being unconditionally hawkish last year to a point of being conditional in their conservative outlook for rates. And they're letting us know that they're going to continue to increase interest rates. And I think this most recent jobs number confirms the point that we should expect another rate increase in March. And it's possible to have another one after that, depending on how inflation numbers go. And they're going to hang out at an interest rate level at 5% or more this year until they get confirmation that inflation is coming down. And where's inflation coming from? Demand. And if we go back to your last segment, we've heard that earnings now are contracting for the year. And as a result, you look at those outlooks and businesses are concerned, will the consumer continue to spend in this environment? And I think our view is that the Fed is trying to slow down demand. They will stay focused on that over the next couple of months, take a pause, but not cut rates this year because the probability of an economic recession might be there and could be in the cards, but not one that's going to be as deep as we've seen in other recessionary environments before. So if you're hoping for a rate cut this year, we think that's more of a 2024 event, and investors should stay still constructive on the markets, but also be cognizant of the risks that still exist in the short term.
And speaking of those risks, I know that you're still watching some inflation in the services sector as well, something we're still not hearing much talk about at the moment. But what do you think that's signaling about where the Fed could be headed this year?
Definitely. Great point, Rochelle. In the services market, we got surprised last week with an expansionary number on PMIs for services, while we're still seeing the manufacturing sector contract. And we're seeing hiring in certain sectors where more support was needed in the short term, and businesses are holding on to their workers because of a tough labor market. So I think what we're seeing right now is a little bit of a false positive coming from the services sector. But because services, 70% of our economy, is supported by labor, we're still seeing people getting paid more than 4% year over year. And yes, those numbers are coming down month over month, which is a good news item in the inflation discussion. But wages are sticky, and wages, I think, will help to keep inflation somewhat elevated over the course of the year, well above the 2% target the Fed keeps talking about. And as a result, we don't expect this level of services expansion to continue over the balance of the year because, again, going back to my earlier point, it's all driven by the consumer and how much the consumer is willing to spend, while still the cost of living is still high and above historical levels that they've recently appreciated.
So, I mean, it's a lot for investors to take on. They're trying to sort through some of this noise here, but you are seeing opportunities, and you like healthcare and financials. We'll start with healthcare. It has been under pressure year to date, but what is it that you like in healthcare? Which companies are the standouts for you?
Thank you, Rochelle. Yes, in the healthcare sector, we think that's an area where you can play offense and defense at the same time. There's a lot of healthcare names that have great free cash flow, showing innovation and expanding their pipelines in the big pharmaceutical space, for example. We're also looking at healthcare insurance providers as a means to help to combat the aging demographic in the U.S. and trying to help to support cost affordability of coverages. So there's areas where the insurance companies, as well as the manufacturers of healthcare and other technologies, are still looking for growth opportunities, while at the same point in time, their free cash flow generation with stable dividends is a good place to hide. On the financial side, it's really more of a mispricing that we think could exist potentially in the sector. Because if we don't hit a deep recession and it's more of a mild or elongated economic slowdown, then financials actually have the next highest free cash flow generation just after energy and look fairly attractive when you look at the value of their stock as compared to the value of their balance sheet. So I would say it's something to keep an eye on as we move forward over the balance of the year.
And as you talk to clients, what are their main concerns in this environment as they try to navigate how to allocate some of their assets at the moment?
Well, I think with everyone coming off of an extremely difficult year from an investing perspective, in 2022, when we see stock and bonds both down double digits, something that we haven't seen since the late 60s, I think right now investors are focusing on where does it make sense to be calculated and taking risk as part of their portfolio. And I'd like to try to not have the same experience I had last year in seeing drawdowns both in stocks and bonds. So what we're trying to do right now is focus on areas of the equity market that has expansion of dividends and free cash flows, still tilting a little bit more to value versus growth stocks. We also think interest rates is an opportunity for the fixed income market because bonds do look fairly attractive, and bonds actually have a chance to continue to rally while stocks are trying to figure out their way over the balance of the year. And lastly, I would just say take a look at some other areas where you don't have to take as much risk. We're getting compensated now for 4% or more in prime money market accounts. And that makes sense as we're trying to move through this noise of what the Fed's going to do and how's the rest of earnings going to go, where you can hide out in a money market fund getting 4% over the balance of the year. And I don't think that's a bad deal in this environment.
Well, there you go. There's definitely some places to put your money to work right now. MJP Wealth Advisors President Brian Verdig, thank you for joining me this morning.
Thank you, Rochelle.
You're very welcome. All right, coming up, the pricing yo-yo continues. Did Tesla cut prices just so it could raise them again? Or is this a more complicated story due to EV tax credits? Yahoo Finance's Pras Subramanian has those answers for us next. It's been a busy couple of weeks for Tesla on the pricing front. The EV market leader has adjusted prices yet again. Let's get the current landscape with Yahoo Finance's Pras Subramanian. More changes here, Pras.
Yeah, Rochelle, you know, this is Tesla just ramming through some price hikes after Friday's IRS ruling that they allowed to change what an SUV classifies for the EV tax credit now using an $80,000 higher MSRP cap that they can take advantage of. So the most recent Tesla price hikes here are for the Model Y long range up nearly $1,500 to almost $55,000, and then the Model Y Performance by $1,000 to nearly $58,000 is the new pricing for those two models. Now these hikes come after these big price cuts last month, where Tesla wanted to make that Model Y more competitive because it didn't qualify for these EV tax credits. So Musk said in the earnings call that demand was outstripping supply. You see the demand sort of improving both here and in China and places like that. So they're able to hike up as long as they can hit that $80,000 price cap. But the key here, though, I think, Rochelle, is that even though Tesla's doing this and Ford sort of matched them, there's no real price or EV price war just yet. You have GM, Volkswagen, Kia talking about how they want to keep their prices where they're at. They think that they're competitive there. So they may not have to raise prices just yet in order to match Tesla.
You have to wonder, though, because I remember when they cut prices in China after people had already bought their cars, there was a lot of backlash, people complaining at some of the outside some of the factories and things. Should we just get used to some of these quick sort of on-the-fly price adjustments from Tesla?
Yeah, and it's not like they haven't done this before. They're able to do this because they can, in real time, change their price on their website, whereas most automakers, they ship a vehicle with their Monroney sticker or window sticker, and that's already set, and they maybe change prices a couple times a year. Tesla can dynamically do this whenever they feel like it, so for buyers, you don't really know what the price is unless you lock it in when you order those models. So I think for them, it's an advantage, but then it can also be a disadvantage when buyers feel sort of that they're being taken advantage of by Tesla not being upfront about what their long-term pricing strategy is.
Well, at least investors encouraged today, seeing the stock price up today. Great stuff there. Thanks to Yahoo Finance's Pras Subramanian. All right, coming up, holding fire. Once again, the world's top cryptocurrency awaits comments from Jay Powell tomorrow. How hawkish is too hawkish for a rally to build some steam? Those details next. Crypto, one of the many sectors that seems to be watching the Fed's next moves, with muted trading suspected to be a side effect of a market that's waiting on that anticipated rate hike. Joining us with more is Yahoo Finance's Jennifer Schonberger. Hey, Jen.
Hey there, good morning to you. Yeah, investors holding their fire ahead of expected remarks from Federal Reserve Chair Jay Powell tomorrow before making any big moves. Given that blowout jobs report Friday showing more than 500,000 jobs that were created in December, investors are eager to understand if that could cause the central bank to raise rates higher than expected. Powell said at his post-policy meeting press conference last week that the job market is still very strong and that there's, quote, still work to do. He said officials will be looking at the data through March and haven't made a decision on interest rate projections, though he said rates could, quote, certainly be higher than what we're writing down now. Back in December, the Fed penciled in rates peaking between 5 and 5.25%. Now, before starting to rebound this year, Bitcoin and crypto crashed last year, in part because the Fed raised rates at the fastest pace since the 1980s to crush decades-high inflation. That caused liquidity to come out of the market and risk assets like Bitcoin to sell off. With inflation showing signs of slowing down and the Federal Reserve slowing the pace of rate hikes, that gave investors optimism that the Fed could be reaching the end of its rate hiking cycle soon. Darius Tabatai, CEO at decentralized exchange Vertex Protocol, said, quote, should central bankers pivot to more aggressive rate hikes again, which is more likely after the jobs numbers came in, that would be bearish for most risk assets, including Bitcoin and altcoins. Though he said the rally would likely resume and trading volumes would probably pick up if Powell commits to staying the course and slowing the pace of rate hikes for at least the immediate future. Powell speaks Tuesday at 12:30 p.m. Eastern in a Q&A at the Economic Club of Washington. Back to you.
We'll certainly be keeping an eye on what that means for institutional investors and how they're feeling about crypto as well. Jen Schonberger, thanks so much.
Thank you.
Well, the wider U.S. economy watching not just the Fed this week, but Congress for whether the debt ceiling fight is likely to have an effect. But do Americans even care? Well, a new poll from CBS News shows us more. Joining us now, Yahoo Finance's Rick Newman. So, Rick, do Americans care about this?
They say they care. I'm a little bit dubious, and CBS has this poll out that I think has some contradictory findings. So just a couple of examples. 55% of people in this poll say, no, Congress should not raise the debt ceiling. But then when asked if Congress should raise the debt ceiling, if that means the United States would default on debt, that drops to only 32%. So people, if you don't raise the U.S. debt ceiling and allow the Treasury Department to borrow more money, by definition, the U.S. is going to default. And that level of awareness does not seem to show up in these numbers, Rochelle. So, you know, my takeaway on this is I don't fault voters if they don't completely all understand all the arcane elements of how the U.S. government borrows money and Congress's role in that. I think when you do a poll, you're sort of forcing people to state their case and to have an opinion. But I just don't think this is something most people are talking about. I'd like to see a poll that says, do you even care about what happens with the debt ceiling in Washington? How much are you paying attention to this? Of the top 10 things you talk about with your family, where does the debt ceiling fall in? And I bet for most American families, it would not make the top 10. However, look, we have to talk about the debt ceiling. We're going to have to do something on this later in the year. As we've been saying all along, and we will continue to say, Congress is going to raise the debt ceiling. It's just a question of how ugly it's going to be leading up to that. And that's going to turn off voters.
I mean, it is natural when you see, you know, both sets of sides of politics sort of wrangling over this and at a standoff that's going to catch the attention of your average viewer. But of course, speaking of political maneuvers, we're also coming up on President Biden's State of the Union address. What can we expect him to hone in on?
Biden's going to be taking credit for a lot of things he thinks are going right in the United States. I'm sure we're going to hear him bragging about the almost unbelievable job numbers from last week, 517,000 new jobs in January alone. This economy just cannot get enough workers and cannot put enough people to work. So Biden's going to take credit for that. He's going to say we're getting inflation under control. He's probably going to remind everybody that he has signed a bunch of bills during the last 2 years that generally do things Americans want to do: fund green energy, fund infrastructure, fund semiconductors. He'll say this is all going to bring jobs back to the United States. Not going to matter a whole lot. I mean, most Americans don't watch the State of the Union speech. It's actually pretty boring as speeches go. We have to talk about it in the media because it's a big media event, but this does not move markets, and it doesn't really move voters very much. But Biden's going to be laying out the case for what could be his reelection run if he decides that he is going to run for a second term as president. So we'll get some clues about where he might be headed with that, at least in terms of the rhetoric in the speech tomorrow night.
And I love that you never sugarcoat it, Rick. It's one of my favorite things about you. I want to ask about this general sentiment from Americans. So then, do they care, or are they too glum to really sort of take on something else right now?
I've been puzzling over this for the last 12 to 18 months. I mean, by some measures, the U.S. economy is in good shape. I mean, the main thing is the job numbers. I mean, people feel like they have job security. The data tells us they do, in fact, have job security. And even some of the tech layoffs we've been talking about, I mean, 4-digit and 5-digit tech layoffs, there's also data that suggests that people getting laid off at Microsoft or Amazon or whatever big tech company are quickly finding new jobs. And those layoffs in tech are not showing up in the overall data. And yet Americans are very glum. Confidence levels are practically recessionary. President Biden's approval rating is still relatively low. It's only 45%. That is not at all consistent with a strong economy. And one thing you can take from that is inflation just really bums people out. People do see inflation happening. It gives them this sense that something's just going wrong. As inflation has come down during the last 6 months, attitudes have improved a little bit, but not very much. So Americans are glum. Maybe that's just what they say when pollsters bother them by calling them up and saying, how do you feel about the country? Maybe they just would rather not be talking to pollsters, and that puts them in a bad mood. But yeah, Americans are kind of bummed out.
Well, that's certainly a theory as to why they're glum over the phone. Great stuff. Yahoo Finance's Rick Newman, thank you for joining this morning. All right, coming up, splashing the cash. How much are we spending and where's the money going? From travel to crypto, we speak with Visa's CFO on the trends you need to know about. That's next. Visa reported a Q1 beat this earnings season. However, the world's largest credit card network saw its revenue wind back to pre-pandemic levels as consumer spending slowed. Here to discuss the outlook for the payment industry is Visa's Chief Financial Officer, Vasant Prabhu. Thank you for joining me this morning, Vasant. So a lot of people have been wondering, what are some of the trends then that are going to dominate the payment space as we really try and grapple coming off the peak of the pandemic and really trying to figure out how the consumer spends right now?
Sure. Thank you for having me. Well, I guess the best way to describe the consumer is very stable. Consumer spending has been very steady for the entire year 2022, steady almost day by day, week by week, month by month. It's about 46% higher than pre-pandemic levels, 2019. But it's shifting. Over the year, it's moved more towards services, away from goods. People are doing things rather than buying things. Restaurants, travel, entertainment are all booming. All in all, consumers have adjusted to inflation. Food and drug is spending. Essentials are quite stable. If you look at spending, it looks like the consumer is still confident and pretty much has stayed confident all the way through 2022 and into January with no real change in trend.
So then what are some of the specific places that they're spending this money? We know that at first there was that sort of pandemic buildup to go into travel and leisure, but then as that tapered off, where is the money now going?
Well, what happened was in 2020, of course, things fell. And then things started to pick up, first in the goods categories. You know, people were at home and there was a big boom in buying things, home improvement projects, apparel, retail goods, e-commerce, etc. And people bought a lot in 2021. As we got into 2022 and economies started to open up, countries started to open up, we started to see people do things they couldn't do. They had a lot of savings in the bank and they started to go out, travel more, go to restaurants, more entertainment, more spending on services. And that's what we're seeing now. So if you look at goods spending, I know it's slowed year over year, and you hear that when you listen to everybody. But if you compare it to 2019, it's doing just fine. It's just that they had a big boom in 21, and now it's the time for travel, restaurants, services, etc., to catch up. And that's where we're seeing the growth right now.
And I want to ask you about another trend that we saw really pick up, especially over the last year, buy now, pay later, that continues to grow in popularity with consumers. And I know you have Visa installment as an option there. What sort of growth are you seeing among clients in that space?
Well, buy now, pay later is another option that consumers have to pay for things. You know, they can do it with a credit card, they can do it with a debit card, or they can try buy now, pay later. And some consumers will, and some consumers are. We help our clients do it. We partner with buy now, pay later providers to also do it. It'll take a while to develop. It's had something of a setback as things have slowed down, but it'll probably grow over time. As far as we're concerned, our job is to enable consumers to pay in whichever way they want. And we will enable buy now, pay later, much as we do all other forms of payment and all other ways that consumers want to pay. And buy now, pay later will have a role to play in the long run.
And speaking of the ways that people pay, obviously still a lot of adults, I think about a third of the global population, perhaps still unbanked at the moment. And I know that Visa has been looking at innovations built on blockchain and things like that. What are some of the innovations and ways that you're planning on really reaching some more of the unbanked?
Absolutely. This is a major priority for us and has been for a long time. Clearly, we've made a lot of progress through the pandemic. If you look at the amount of credentials or cards out there, they've grown quite a bit in the last couple of years and are growing fast still. A variety of new ways to enable consumers to pay digitally have emerged around the world. Wallets, for example, digital wallets, very popular in emerging markets. We're partnering with most of the digital wallet players. Our credentials are embedded in these wallets. In many parts of Africa, people use their phones to pay. They work with the telecom companies. We're partners with the telecom companies across Africa. Again, we embed our credentials. This is another way in which people are empowered, and brought into the digital economy, the financial economy. Of course, we work with a whole range of other players to enable people to have bank accounts as a way to get access to digital payments and our ways to pay. So there's a whole range of possibilities here. And in fact, it's growing as technology has improved, and a significant amount of movement into this space has happened in the last 2 years. And of course, blockchain will have a role to play. We do partner with a variety of people who provide cryptocurrency services. We don't have a point of view on cryptocurrencies per se, but we do partner with people who allow people to buy and sell cryptocurrencies, which can be helpful to people in countries where the local currency isn't that reliable. So it's a major initiative. It's multi-pronged and will go on for a long time.
All right. Well, I do thank you for taking the time to join us on Yahoo Finance this morning. Visa CFO Vasant Prabhu, and congrats on the past quarter, a bumper quarter indeed.
Thank you.
All right, coming up, Harry Styles capped off a golden night at the Grammy Awards, taking home the coveted Album of the Year prize. Ali Kanal has her top takeaways from music's biggest night next. Hollywood rolled out the red carpet for the music industry's biggest night last night, the Grammys. Yahoo Finance's Alexandra Canal joins us to break down her top takeaways. So, Ali, what did you think of the show?
Well, Rochelle, I personally think the Grammys, they're one of the most fun award shows out there. It's always high energy. This year was no exception, and there were a ton of big moments. But for me, I'm going to focus on my top 5. Number 1, of course, being the Queen, Beyonce. She now has the most Grammys of any artist with a record 32 wins after taking home Best Dance Electronic Album for Renaissance. However, she did not win Album of the Year, and probably the biggest surprise of the night, that top award went to Harry Styles for his album Harry's House, which also won Best Pop Vocal Album. So big congrats to Harry there. And then another big moment that stuck out to me was that star-studded 50 years of hip-hop performance with artists from Mary J. Blige and Queen Latifah to Nelly and Jay-Z all performing. And then on top of that, we had some pretty groundbreaking moments as well, like Kim Petras becoming the first transgender woman to win a Grammy for Best Pop Duo Group Collaboration for her song with Sam Smith, Unholy. And then finally, Viola Davis earning EGOT status for her Best Audiobook win, which is such a huge accomplishment for any performer. And for those of you who don't know what an EGOT is, it's someone who wins an Emmy, Oscar, Grammy, and Tony Award. So basically a quadruple level talent there. So big congrats to Viola. And overall, I think a lot of big moments, a few surprises, but I think a very memorable show at the end of the day.
I mean, I know people online, a lot of big question marks there over that Beyonce loss. But of course, another big question among the viewers, what's the difference between the Song of the Year and the Record of the Year?
And that's a great question, Rochelle. I think I've wondered that at some point. I think a lot of people wonder that. And according to the Grammys website, Record of the Year is awarded to the entire team behind the recording of a song. So the artist, producers, engineers, everyone who contributed to that record. And then a Song of the Year is the composition of the song and recognizes the songwriters. So that's the two main difference here. I'm very happy about the Record of the Year win, About Damn Time for Lizzo. Lizzo. She is such a great performer. Her speech was super memorable. And then Song of the Year came as a bit of surprise, just like that, by Bonnie Raitt. So that is something that I think people were not fully expecting. But again, that has to do more specifically with the lyrics and composition rather than the actual recording.
I know that category is one that my beloved Amy Winehouse won for Rehab back in the day. Did you have a favorite performance of the night? Mine was Stevie Wonder, but I'm biased because I absolutely love him. Did you have a favorite?
I'm just going back to that 50 years of hip hop. I just think it was so iconic. There were so many artists that we haven't seen in a really long time. Jay-Z, I just love seeing him perform on stage. And we had that boycott of the Grammys not too long ago. So the fact that he came back and was on stage to perform this. Questlove was the mastermind behind all of this. He's been on Yahoo Finance before, and I feel like he's such a visionary in the music space. So I think that would be my winner. But there were a ton of solid performances, and that's what makes the Grammys so fun. There's just so much energy, so many artists, and I think it's a great night. So I'm very curious to see how that translates to the TV ratings.
Indeed, we'll be following up on that. Thanks so much, Ali Kanal, for that update. All right, well, before we go, let's do a final check of the markets as we head into the noon hour. Off their session lows, but still in negative territory. You see there the Dow there off about 112 points. The S&P 500 there down just slightly there as well, down about 30 points. And the tech-heavy Nasdaq down 0.8% there, digesting not just earnings, but expectations for the Fed and the possibility that these rate hikes are going to stick around for quite a while longer. Well, that does it for now. I'm Rochelle Akufo, but do stay with us here. We'll be back at 3 p.m. Eastern for our afternoon shows. I'll be back at 11 a.m. Eastern tomorrow. I'll see you then.